his flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stocks pushing higher this morning as investors brush off tariff concerns and celebrate President Trump's plans for AI infrastructure. The president said he was still considering a 10% tariff on all goods from China. But traders are more focused on the pro-business policies that he announced. Trump unveiled SoftBank, OpenAI, and Oracle are forming a joint venture dubbed Stargate that will see an initial investment of $100 billion for artificial intelligence with a goal of increasing investments to at least $500 billion.
Plus, Netflix shares are surging this morning after the streaming giant announced that it finished 2024 with the largest subscriber gain in its history. It was more than double what Wall Street expected, very much driven by a push into live sports and the return of Squid Game. Meanwhile, United Airline shares are moving to the upside here this morning after the carrier's fourth quarter earnings and forecast came in ahead of estimates, lifting shares of American Air and Delta too.
And when it comes to the sale of TikTok, Trump says he would be open to Elon Musk or Oracle's Larry Ellison buying TikTok in partnership with the U.S. government. The president told reporters that he has the rights to make a deal and the app could be worth trillions or nothing at all without it. Meanwhile, other bidders are already lining up. A group of investors, including the internet's top creator, Mr. Beast, and tech entrepreneur Jesse Tinsley submitted an all-cash bid for TikTok, but details of the offer and investors have not been disclosed. President Trump holding a wide-ranging press conference on his second day in office, talking everything from AI to tariffs. Investors breathing a sigh of relief when it came to trade, though. Here's what he had to say on China.
We're talking about a tariff of 10% on China based on the fact that they're sending fentanyl to Mexico and Canada. Probably February 1st is the date we're looking at.
The latest threat of 10% tariffs on Chinese exports is far lower than the 60% he mulled at one point last year. And taking a look at the market's reaction, this really tells the story. And I think when you take a look at some of the developments over the last 48 hours or so, you very much are seeing markets shrug this off. And that has very much been the sentiment since we had the inauguration on Monday. And when we didn't get too much detail, now we are getting some detail, and it's clearly not as bad as maybe the markets has feared at this point. And I think it's that also coupled with the fact, and Brad, you and I have talked to so many strategists here over the last several weeks, that this is very much viewed, I think, at this point as a negotiating tactic. That was also echoed by Scott Bessent during his hearing just last week. So I think the market is very much still in a wait and see mode. Yeah. You're seeing that play out in the equity markets, also in the currency markets as well. A bit of a reaction in the yuan. But again, when you take a look at Canada's currency, when you take a look at the Mexican peso, we're not seeing too much reaction there either. Yeah,
one of the reactions that we did have from UBS is their base case essentially being growth despite tariffs. That coming from Salita Marcelli, who's the Chief Investment Officer for the Americas for UBS Global Wealth Management, and going on to say they believe it's most likely a combination of resilient U.S. economic activity, solid earnings growth as well here. Calendar year S&P 500 projections from FactSet are sitting at about 15% for the entire year. It's likely that we'll see some type of adjustment. That is typical, but also in tandem with the UBS call, lower borrowing costs and the potential for greater capital markets activity as well, leading stocks higher over the balance of 2025. They assume here and are projecting, and in their base case, they see the S&P 500 reaching 6,600 by December. And so all of that considered here, we're continuing to see, as you were mentioning, a little bit of that shrug off take place here this morning. Yeah, when you take a look at the market's reaction, trying to figure out what exactly is driving it, a lot of it is the AI excitement, the announcement that you were just talking about moments ago from President Trump, and also many of the larger tech giants that are part of this venture that is looking to raise a significant amount of money here, up to $500 billion in AI investment in the U.S. NVIDIA, Microsoft, ARM are also some of the players involved, in addition to SoftBank, Oracle, and OpenAI. A lot of that excitement, again, very much overshadowing some of the caution, maybe, if there is any, when it comes to tariffs at this point. And that coupled with the results that we got out this morning from Netflix as well, very much reigniting this risk-on sentiment that we are seeing this morning. When you take a look at the top trenders here on Yahoo Finance, the names up on your screen right now are very much in that mix here of the most active here ahead of the bell. You know, I kind of harken back to what we had heard from Mohamed Al-Arian yesterday, where he was saying that and especially knowing that Trump uses the market as a barometer and has known that the AI trade has been the larger theme to this point that's really been continuing to fuel the bull market. One of the larger things that Mohammed Al-Arian told us during our conversation yesterday is, and reminded, that you can't go to heaven on the same deed twice here. And so thinking about how much we've already seen in the additive that AI has been into the market performance here, 20% here for two years of returns of over 20% for the S&P 500. He said we still have to be realistic that it's not often that you get 3 years of over 20%, but if you do see some of these major investments continue to move forward in partnership with government, there is a larger inclination to try and evaluate or run the calculus around, well, who would be the largest contributors at that juncture to continue thrusting even more of those market gains forward from here.
All right, well, big tech's Stargate AI investment is the latest move in a broader push by the new Trump administration to drive U.S. leadership in AI development. On day one, President Trump rescinded guardrails put in place by the previous administration and has enlisted prominent tech figures like David Sachs and Elon Musk to lead his administration's AI policies. Joining us now, we want to bring in Ed Mills. He's Raymond James, a Washington policy analyst and managing director. Ed, it's great to have you on here this morning. So very much AI front and center on the heels of this announcement that we're getting from the Trump administration here over the last 24 hours. I'm curious just in terms of maybe to you what this signals about where Trump's priorities lie, and maybe what this also tells us about future investment and future priorities here over the next 4 years.
So, Shauna, if you want to know what Donald Trump cares about above all else, it is investment in the United States. I think this is really interesting to see the fact that Japan, once again, with Moise-san, is leading these efforts. In the Trump 1.0, the relationship between Japan and the United States was arguably the best. And we had Abe's widow down in Mar-a-Lago announcing $100 billion a couple of weeks ago. Now it's already at $500 billion. Trump is going to want to say it's going higher. He wants things in the United States. And then as it relates to AI, there was a rule out by Joe Biden just last week that wanted to keep it even more in the United States, make sure the chips stay here. I expect that rule to stay, because if we can keep AI in the United States, that is a national security prerogative and a big boost to the U.S. economy.
And so even as we're hearing some of that and showing some of the companies on screen here a moment ago, Ed, that are early members of the partnership here, a lot of those have international ties, to your point, as you were mentioning. Where does the cutoff start to emerge? Where does the administration eventually have to say, okay, this is too much international or foreign investment that's also going to have an ear into some of the information and the data and the research and development that's coming forward from the U.S. companies that they had brought previously forward as being a national security concern, if there were some of those other entities that did have access to that information?
Yeah, so under the rule that was announced last week is that if you're US based, you need to have at least 50% of your chips here in the United States and 75% of the chips with the United States in our closest allies. Only 25% of those controlled chips can go outside of what is a new wall that has been built among the United States and our closest allies. As you mentioned at the top, there was a rescinding of the executive order on AI by Biden. So the models used to have to be submitted to the government to get approval to move cross-border. My expectation is there'll be something that comes back that tries to limit models for national security purposes, that this is not going to be a completely hands-off kind of topic by the Biden administration or by the Trump administration, but they just thought the Biden administration had gone too far in trying to regulate everything.
Let's talk about the latest developments on tariffs. We heard President Trump threatening to hit tariffs on China here, about 10% tariffs across the board, obviously much lower than what had been initially talked about, or some of the rhetoric going back to the campaign trail. But he's targeting China, he's targeting Canada, he's targeting Mexico, also Europe. The market, though, is very much brushing this off. Why do you think that is?
Yeah, isn't it so fascinating, Shauna? We had a macro call yesterday here at Raymond James, and I asked everyone on that call, what do you think is the probability, or kind of do you think that there's going to be a universal tariff imposed this year by Donald Trump? My vote is yes, but 73% of the investors on that call said no. So to me, if we actually get a tariff on February 1st, on China, on Mexico, on Canada, The market's not pricing that in. Now, I think there's a lot of positive things to the economic agenda that the Trump team wants to do. And Team Econ is trying to tell him, go incremental, don't go too far, too fast. But Team Trade is really pushing for him to go very fast, very hard. The establishment of the ERS, this External Revenue Service, shows you just how committed they are to tariffs. So, Shauna, you said maybe it's not as bad as you fear. One of my truisms about DC is it's never as bad as you fear, nor as good as you hope. The market right now is pricing in good as you hope. That's always a dangerous place to be.
Ed, just lastly, while we have you, I want to get your reaction and the significance of delaying the ban of TikTok and now some of the preferred candidates who some of them are what's old is new again and potentially purchasing the social media app, at least the U.S. operation of it.
Yeah, Brad, the challenge for me here in all the conversations I've had with clients of Raymond James is this tension between the executive order and this desire of Donald Trump to be the transactor and what's in the law. So under the law, TikTok is not allowed to currently operate here in the United States. There is an ability for the president to extend it out 90 days, but there's supposed to be a contract. And under the law, there's a $5,000 per user fine. That's $85 billion if you add up 170 million daily active users. So I know that the Attorney General is not supposed to impose this, but there's also state attorneys general. There are private parties. So we're in a very tenuous situation. My expectation is as long as China's willing to sell that, this is a deal. But there's still a lot of question in my mind and questions that come into Raymond James on whether or not China's willing to sell it. That, to me, is what I'm focused on.
All right, so I guess I'm costing TikTok $5,000 per day every time I tap on just to try and get some advice. Ed.
Or those who host it.
Or those who host it. There you go. Ed, thanks so much. I appreciate it.
Thank you.
Netflix soaring after beating fourth quarter estimates, raising its 2025 revenue forecast, and adding a record nearly 19 million subscribers here. Joining us now, we've got Michael Pachter, who's the Wedbush Securities Managing Director of Equity Research. Good to see you, Michael. Revenue rose 16% from a year ago. Do you actually expect the ad tier to be the primary growth driver for revenue by 2026? I know we have some people in the newsroom, maybe even one at the desk, who have opted into that ad tier as well here. So what are your anticipations, and just walk us into that expectation?
I think that the ad tier was introduced because the company recognized that as they kept raising price, the ad-free tier was already the most expensive streaming service and, was going to remain there. So they wanted to offer a lower priced option. I think that this exceeded their wildest dreams. What it allowed them to do was talk people who quit into trading down to an ad-supported tier. So until yesterday, it was $6.99 plus ads compared to $15.49. They're now raising price to $17.99 for the standard plan, and the ad tier is at $7.99. So less than half as expensive. And the truth is, you churn out a Netflix only because you're not watching it as much as you used to. And I think a lot of people on a stretched budget were trying to balance their spend on Netflix with other streaming services. This allows you to kind of keep Netflix as your core subscription at a pretty low price, whether you watch it or not. It's, it turns into, pennies per day as opposed to, dollars. And truthfully, I think that they're seeing such success. That's why you saw the record numbers. They're now figuring out how to deliver ads to those people and to monetize them better because they're targeting a lot better. So again, churn has all but evaporated. Some people are quitting, but most people are trading down, and that's why they've added something like 80 million ad-supported subs, but they've only added like 40 million overall net subs. That tells you 40 million people didn't churn out, they traded down. It's a big deal.
Michael, when you take a look at some of this momentum that we've been talking about that's behind Netflix right now, a lot of that being attributed to the content, the live events, the sports offerings that they do have. Here's what Netflix co-CEO Ted Sarandos had to say when he was asked about the possibility of full season sports rights. And then, Michael, I want to get your thoughts on the other side.
We are constantly trying to broaden our programming, and live events is one of those things, and sports is part of that. So if there was a path where we could actually make the economics work for both us and the league, we certainly would explore. But right now, we believe that the live events business is where we really want to be.
Curious, Michael, just to get your thoughts, what strategy do you think makes the most sense for Netflix right now as they do approach the future of live events in sports?
Yeah, Ted kept talking. I think he probably got another question a little bit later, but for the first time ever, they sounded intelligent about this because I thought they'd been pretty stupid in the past. They can't compete with Amazon and Alphabet. YouTube TV has Sunday Ticket. Amazon has Thursday Night Football. Those guys are competing for basketball. Netflix will never have enough money to compete with those guys. And Ted said later, we're trying to do special event programming. So Women's FIFA World Cup, once every 4 years, a few weeks of broadcasts, which is really smart, or Christmas Day games, but we're not going to bid on the whole package. And I think that's right, and I think that's smart. When you look at the Sunday Christmas games, the Christmas NFL games they did, they reportedly paid $150 million per game, and they paid for Beyonce. Now, Beyonce turned into lasting content. My wife just watched it again yesterday, so it's still there, it's archived. But it's really not worth it to spend $150 million on something that's 3 hours long and is over. And I'm glad that they're not doing that. The key here is they're just trying to be the place that we all go for everything. They want to have something for everybody. So they have anime, they have documentaries, they have, obviously many foreign language programs. So again, sports is a bad idea. Live events, WWE, good idea. Ad supported, so it drives a lot of ad revenue. It happens frequently enough that people tune in and they don't quit because they're watching the service at least once per month.
Michael, who's the streaming service that you expect to fall off if Netflix continues to entrench itself?
Paramount Plus is kind of a joke. And I say that because they have one amazing creator, Taylor Sheridan, and pretty much nothing else. So, all the shows that you've heard of that are on Paramount Plus were produced by the same guy. I like the guy, I like his shows. I just finished Landman. I highly recommend it. But what happens if he gets poached? They're screwed. So I think that one's in real trouble. I'm not sure that Peacock makes as much sense, now, because Hulu obviously is a competitor with similar content and is better capitalized. Again, Disney is better capitalized. Comcast has that problem that they're losing their core subscribers. People are migrating over to streaming. They're not migrating over to Peacock. So I think those two are in most trouble. Max and Disney Plus are here to stay. And then obviously there's lots of smaller guys.
All right, Michael, always great to get your insight. Landman, I haven't checked that out yet. I got to add it to the list. Michael, always great to have you. Thanks so much for taking the time to join us here this morning. Coming up next here on Morning Brief, we're going to count you down to the opening bell on Wall Street. Plus, we'll dig into earnings, this time from United Airlines. And we're also going to get you prepared for Trump's tariffs. All that and more on Morning Brief.
We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, J&J, Johnson & Johnson. J&J is the ticker symbol, and it surpassed Wall Street expectations in the fourth quarter, reporting over 5% sales annual growth driven by strong cancer drug sales. Growth was partially offset by the company's psoriasis treatment, which is facing increasing competition in the U.S. and Europe. J&J sees operational sales growth between 2.5% to 3.5% for 2025. The pharma firm is awaiting for court approval of an $8 billion deal that would settle claims related to its talc products. The decision is expected this quarter and could remove a longtime concern for investors as well. Shares right now, though, they are down by about 3%.
Plus, Procter & Gamble beating on the top and bottom line in the second quarter. Organic sales increasing 3% from the prior year, much of that driven by a 2% rise in volume. Pricing had a neutral impact on sales growth, that's according to the company, meaning shoppers bought more items and that sales increase was not due to higher pricing. This is a change from prior quarters where growth came from higher pricing. Companies are under pressure to help slow inflation.
And finally, United Airlines surpassing expectations in the fourth quarter and laying out strong guidance for the first quarter, seeing adjusted earnings per share between 75 cents and $1.25 on the upside versus the 56 cents estimated. CEO Scott Kirby says the airline is entering 2025 with accelerating demand trends, putting the company on the path to double-digit pre-tax margins. The airline industry has benefited from higher fares. Prices in December were up nearly 8% from a year prior. That's according to the Bureau of Labor Statistics.
Following strong results from United Airlines, our next guest is saying that there's more to the numbers than just growth in premium revenues. Joining us now for more, I want to bring in Mike Boyd. He's Boyd Group's international president. And Mike, let's start right there. What is driving then a lot of this excitement and a lot of this growth?
Well, I think a lot of the projections were made basically on what United Airlines has been, not what United Airlines is becoming and what they're doing. Remember, this higher premium revenues are coming from higher premium routes. This is an airline that's looking at the future, particularly internationally, with places like Marrakesh. Who wants to go to Marrakesh? Well, enough to fill up a couple airplanes in the premium cabin. Or Nook, wherever that was, we didn't know where that was, then Greenland. They're adding routes like that because they see they can get a lot of premium revenue there. They're not done with that. So I think the projections in the future really need to take into account what United is doing going forward, not what they did in the past, because that going forward looks pretty strong to me.
It sounds like it's a lot of focus on the international and trying to extract premium value from international travelers here with some of the routes that you were mentioning, Mike. You know, as we look at the last year, this was and it wasn't even close, the leader in terms of share value return to shareholders. So do you expect that to continue here, especially as they're making some of these larger investments and investors perhaps going to be looking across what that spend looks like to either add on additional routes and capacity or just to focus in more on extracting more margins from some of those premium customers?
They're looking at opportunities, and opportunities are more than just in the front cabin, in front of the curtain. What they're looking at is where traffic may grow in the future. As I've said, they were the biggest U.S. carrier to China. China's gone, ain't coming back. It's about 15% of what it was. They have recovered from that beautifully, and they're looking at other markets going forward. But even domestically, when you look at how they've been hamstrung by Boeing not delivering airplanes, their performance is really quite outstanding. So I think what it is, this is a company that can look at, I would say, adversity and make a lot of money out of it.
Mike, let's talk about what the incoming Trump administration means more broadly for this sector. There's been some excitement. Brad and I had the chance to speak with Bob Jordan, the CEO of Southwest, not too long ago, and he was saying that he was pretty optimistic just in terms of what the Trump administration is going to bring here for the industry at large, talking a lot about a lighter regulatory approach. How do you see that influencing airlines?
Well, I think airlines have been put on notice. You can't keep messing around with passengers. As I said, United Airlines is one of the first to recognize that, because very often when you buy a United ticket, you're not flying on United, you're flying with United with all the messages you get. That's positive. But we're not going to have any more games like we saw last week where Buttigieg decided it was going to fine Southwest Airlines for chronic delays that took place 2 years ago. We're not going to see games like that going forward. I think Sean Duffy is going to be a much more focused person. And don't kid yourself, the airlines aren't going to get away with murder on this one. They're being held accountable, and I think Mr. Duffy and his team will continue to do that.
Mike, with all of this in mind, it sounds like from the FAA perspective, and in our conversations with Bob Jordan and with Delta CEO Ed Bastian, they're all looking for changes at the FAA and air traffic control specifically as well, and adding on more staff, because that's where it seems like from the executive level they're feeling hamstrung and just not being able to get as many flights into the skies because they have to wait in the queue and wait to make sure that they can ultimately not just bring more routes on, but that the air traffic control has capacity to direct that as well.
Yeah, the point is the FAA has been horribly managed for the past 30 years or so. I've said you need to take a bulldozer to the front office and completely clean it out. But I think Mr. Duffy will be able to do a lot of that. We need more controllers, and the FAA literally has been a problem. Remember, Boeing's trouble with the MAX, Boeing's trouble with that Alaska door plug. The FAA was there the whole time watching this, never did anything. Now they act like they're the cavalry coming over the hill to save America. I think that's going to change going forward. We've got to get more controllers there, but we've got to get oversight of the FAA out of the hands of politicians.
Mike, always a pleasure to get some of your insights. Thanks so much for taking the time here with us today.
My pleasure.
Coming up, everyone, we're counting you down to the opening bell on Wall Street. Stay tuned. We'll be right back.
And that's the opening bell on Wall Street. Let's do a check of the markets as we kick off another trading day here on Wall Street. Again, we are looking at gains here at the open. When you take a look at the fact that investors very much shrugging off much of the concerns surrounding tariffs and focusing on the AI announcement that we got from the Trump administration yesterday. Also, the strong earnings that we got out this morning, namely Netflix, that stock is soaring this morning. Also, some positive reads on the consumer when you take a look at P&G, when you take a look at United Airlines, adding to that risk on narrative here this morning. So you've got the Dow opening up just about 0.3% to the upside. You've also got the S&P here, above 6,000 here, up just about 0.5%. Also the NASDAQ moving to the upside, very much at risk on trade being felt within some of those larger tech giants here. You got the NASDAQ 100 also moving to the upside there, a gain of nearly 1% here at the open. Taking a look at the bond market, a bit of a move higher here in yields, but just a bit. We're still below that 4.6 level. Let's flip over to the sector action and an early read, very much showing that technology is the driving factor in some of today's moves. You got technology up just about 1.3%. Communication services not too far behind. Consumer staples also in the spotlight here this morning following the results that we got out from Procter & Gamble and some of the other names there. Industrials amongst the leaders there. In terms of laggards, you got healthcare and real estate. Johnson & Johnson weighing on some of those healthcare names. Let's take a look inside the NASDAQ. We were talking about the outperformance of some of these tech giants here. You got NVIDIA up just about 3%. A lot of that excitement being attributed to what we heard about the pact, the venture pact that was unveiled by the Trump administration yesterday. Also Microsoft, part of that, that's up just about 2%. You're also looking at Meta, Amazon, Google, the companies that had some of their founders or CEOs with the large presence at the inauguration earlier this week, moving to the upside here during the first couple of days of the Trump administration. Let's kick it over to Jared Blickery for a closer look at some of the other movement that we're seeing. Jared.
Thank you, Shauna. I am looking at the S&P 500 within a hair's breadth of its record highs. We're looking at the 10-year. I'm going to switch over to the S&P 500, a 2-month chart. Here are the record highs. Now, intraday, we're looking at 6,099.97. On a closing basis, it's 6,090.27. So we're only 7 small points away from that right now. Easy to think that in a few hours, we're talking about a potential record closing high here, but I don't want to get too far ahead of myself. Also want to mention really the breadth that we're seeing in this latest rally over the last week or so has been incredible. I have a stat for you that comes from Jason Gephardt. 2 out of 3 S&P 500 stocks, that's at least 333 of the 500 stocks, have closed in the green for the last 6 days. That has never happened in the 97-year history that we've been tracking these things, although I haven't been around that long personally. Let's take a look at the U.S. dollar index. After that big drop on the inauguration day, it's just kind of sitting by its 2025 lows, not causing any problems for anyone. The U.S. yield situation is pretty similar there. These are the sectors, and we're looking at some outperformance by the mega caps here, but I want to go to the NASDAQ because Amazon, much like the S&P 500, that is nearing its own record high, and I'll put a 3-month chart on there. You can see right up against those levels, might be there pretty soon. And then Apple, which is moving the opposite way, that has now fallen to its 200-day moving average, sitting right there. So we'll see if there's any respect for that technical level. We're not going to call it support until it actually acts as such. Also want to show you what's going on in the semiconductor space. The SOX index, so that's an index of most of these stocks here, that is up to a 3-month high. And you can see NVIDIA here up 3.3%, not quite as close to its record high as Amazon, but it is fairly close right there, closing in on 150 after hitting 145. I'm going to end on gold because gold has been rallying on good news and bad news over the last few days, and that's not it. Let's go to the future section, and here we see GC equals F, if I can find it. That has just been on a tear, and it too is closing in on its record high, and I think that's good for about a 2-month high that we're looking at right there. So just a broad risk-on rally here, guys.
Jared, thanks so much. Appreciate it. Setting up today's trading activity for us. Now time for some of today's strategy session here, where we're seeing some investors seemingly brush off tariff concerns for now, as the issue lingers in the backdrop. President Trump yesterday confirming his plan to impose a 10% tariff on China and 25% on Mexico and Canada. Joining us now, we've got Jeff Grumpelman. He is the Chief Investment Strategist and Head of Equities at Mariner. Jeff, good to see you. Thanks so much for hopping on just after the opening bell here. You know, how critical is it for us to also get a sense of where and how targeted the tariffs would be, especially on certain goods or categories, before just thinking about sweeping 10% or sweeping 25%?
I do think that that's pretty important. I mean, if you back up and you look at what tariffs in terms of their inflationary influence I think, labor market conditions are far more impactful, and deportation strategies, for example, I think could have much more influence on inflationary trends. But to your point about being targeted, I do think that as we saw back in 2017, 18, the real focus was China. Very little happened in rest of world. And China, both, it makes sense in terms of diversifying supply chain out of that area, protecting our intellectual property rights, and to work on trade there, I think is important. And I think that the growing evidence that the issues with Mexico, Europe, our friends, are much more, they're not trade oriented. It's much more oriented towards other initiatives, like let's slow down immigration, let's stop the drug trafficking, for example, and a prelude to negotiations with the North American trade agreements with Canada and Mexico later in 2026. So I do think it's important that it be targeted, and that would be much more or less disruptive. And I would also add to this, you can do a lot with China via executive order. You can do a lot quickly on that front. This fear that it's going to be broad on every product throughout the world, including with our friends, you're going to need congressional approval to do that. You can claim national security issues with China through the International Emergency Economic Powers Act. You cannot do that when you talk about tariff negotiations or employing tariffs with our friends and allies.
Jeff, what is the bigger driver or driving factor here for the markets over the next several weeks and couple quarters? Is it the policies that we're getting from the Trump administration, like what we're hearing on tariffs, or is it much more so the earnings story and the importance there that we need to see in terms of that growth expanding beyond big tech?
Let me give you a great answer. Yes. I think it's both. And as you know, our thesis this year is clear air turbulence, which means we're going to get to our destination. And we do think the market will be up 12% or so based upon those fundamental factors you just mentioned. Earnings, the economy. We're getting some very solid data on both fronts. This earnings season's going well, holiday went well, retail sales are going well, auto sales are on fire, employment's good, so on and so forth. All that stuff is important, and it will carry the long-term day. But what's going to create the air pockets in that blue sky fundamental data is going to be potential tweets, whether it's just, kind of general stuff about, well, we're going to, absorb Canada as a state, or these initiatives, they're transitory in nature, and there's a lot of unknowns. I think some of those announcements will scare people, some will excite people. And so the answer to your question is yes. Keep your focus, however, on the fundamentals. And that's what will drive decent returns with heightened volatility as these headline issues come out.
Jeff, what we've seemed to continue to hear is that there was going to be a potential correction in the first quarter or the front end of 2025, but still some of these targets for growth for the S&P 500 for the full year. Walk us through your calculations.
Yeah, and strategists, I would say that a number of folks, we try and get cute, right, and talk about timing. I think if you can get the year right, that's the main thing. But there is I think, prevailing kind of thesis that when we, in the first 100 days, hear news about tax cuts, and we get news like we did yesterday about AI investments, and you have these deregulatory kind of thoughts that come out through executive order, that will excite people. And I do think that CEO and small business confidence is up, and therefore that you get a push in the beginning, the first half, and then people start to really get a little more sober and see offsetting issues from some of the initiatives, and perhaps you kind of tail off at the second part of the year. I actually think it very well, if forced to get cute, could be the opposite. And it's very typical in a post-election year where you get some drag in the first quarter. There might be people that when we breach 6,000 say, wow, man, I need to take some capital gain. I didn't want to do that last year and pay the tax bill in 2025. I'll take them now, though, in 2025 and pay them in 2026. And I think that the bloom might come off the rose just a little bit on some of the growth initiatives that you have out there. But that said, I got to tell you, we look tired going into the end of the year, technically, if you looked at advanced decline and percentage stocks trading above their moving averages. And as we have gone into 25, that's perked up a little bit. So, time will tell. I'd say don't get too cute. And we say 6,600 at the end of the year, and we're going to leave it there.
All right, Jeff, thanks so much for your insight there, Jeff Krumpelman. Well, it's time now for our chart of the day. Let's send it over to Catalyst co-host Madison Mills for a look how President Trump's agenda on tariffs could impact markets and the Fed. Maddie.
Yeah, we're getting more insight into President Trump's potential tariff policies. Remember, on the campaign trail, he had spoken about 60% tariffs on China. The Tax Foundation estimating that a 60% tariff on China and a 20% tariff everywhere else in the world would cause an average tariff rate of 17.7%. Apollo economist Torsten Slok saying that could cause a jump up in inflation by as much as 0.5%. He also notes this could push the Fed, of course, to raise interest rates again to fight any inflation off of that. But this chart does assume higher tariffs than we may end up getting. Let's listen to the latest from President Trump on tariffs.
We're talking about a tariff of 10% on China based on the fact that they're sending fentanyl to Mexico and Canada. Probably February 1st is the date we're looking at.
And Trump also teased out potential tariffs on Europe in that conversation with reporters. So why the shift? A couple of potential reasons. Perhaps Trump is leaning into deal making now that he's in the Oval Office. Perhaps Treasury Secretary Scott Bessent is in his ear. We know from our conversations here at Yahoo Finance that Bessent is in favor of lower tariffs on China overall. But regardless, we are seeing this playing out in commodities markets here. Oil continuing to move to the downside, and crude and Brent here on your screen. And you've also got gold sitting at around an 11-week high, guys.
All right, Maddie, thanks so much. We're going to continue to track that, as we know you will too. Coming up, Salesforce CEO Mark Benioff talks the future of AI and its impact on the job market. That's next on the Morning Brief.
Yahoo Finance on the ground at the World Economic Forum in Davos, Switzerland, and one of the persons we always talk to at Davos, that is Salesforce co-founder and CEO Mark Benioff. Mark, good to see you. This is not going to be a podcast, so I don't have tons of time with you, unfortunately.
Great.
So let's come out of the block blasting on AI.
Faster the better, actually.
Faster the better. Okay, faster the better. AI, what's the job market impact to AI?
Well, and, you know, technology is always getting lower cost, easier to use. It's going faster than ever, but, you know, technology is always impacting jobs. And so we're going to have changes in jobs. And we talked about this already, like just at Salesforce, for example. You know, we've put Agentforce on top of our customer support platform. We have 9,000 support agents. We get about 36,000 customer support inquiries every single week. If you asked me a month ago, I'd say about 10,000 of those had to go to humans. Now with Agentforce, only 5,000 are going to humans. So I can now rebalance those customer support agents, and I'm going to ask them to move into different jobs inside the company where I have a lot of needs in other areas. So this is an exciting moment.
Do you think the workforce, the global workforce, will be massively, do they have to be massively retrained to work a lot of this technology coming at them?
I find that I am retraining myself. Like, I'm working on my business plan for fiscal year 26 that starts February 1. So I'm actually working on writing the vision statement, the values, the methods, you know, how I'm going to accomplish all the things. I want to make every company an Agentforce company, the obstacles, the measurements, and I'm using AI for the third year in a row to do that. So I'm working with the AI, I'm talking to it, it advises me, I ask it about how what I'm doing compares to my competitors, where my gaps are, how I should fill in, and it's been amazing, but I've had to learn how to do it. And as an example, I'm bringing an executive with me this year, and somebody new who's never worked on with me before, and they were just kind of sitting there with their mouth open, not understanding how I was working with the AI to achieve my goal. So I think that for all of us, whether you're a CEO, a journalist, or a support worker, a sales worker, a marketing worker, no matter what you're doing, you're going to have to reach a doctor, radiologist, you name it. Everybody's going to have to retrain themselves to be productive with AI.
Two questions. One, you've been keeping a running tab on how many Agentforce deals, and you've shared that with me in the past. How many deals have you signed, and what is the...
We're in the thousands.
All right, what is the... thousands now?
We're in the thousands.
That's
huge.
huge.
You know, we did 200
I just talked to you a couple
in Q3.
months ago.
I know. Well, this is going way faster than anything we've ever done, and it's been amazing, and it's very exciting. And look, I'm shocked at how fast it is going, but you know, here at the World Economic Forum, they've used our platform for more than a decade to run all the sessions and contacts and how everybody finds their way through this. But this is now an Agentforce operation here, and it's agents and humans working together in Davos to make a more successful Davos. I just showed you the app.
Yeah,
so
wild
were
app.
you surprised?
Yeah, I was surprised. I was surprised by the speed, Mark, of how fast things come up. And to that end, what is the consumption? Like, people that are now have agents in their business, what's the consumption? How aggressively they are using this technology day to day?
Well, I think that, a year ago, nobody had anything like this or could even conceptualize doing anything like this. So we are at the beginning of an incredible journey for every company. And every CEO that I meet with, I just talk to them about, hey, what's your path to becoming agent first? How will you build an agent first organization? And I'm trying to model myself and show that I'm doing that.
I'm sure you saw the news, Stargate, AI infrastructure fund by the Trump administration, some Microsoft, Oracle, all those names are in there. Were you involved in that, and what signal does that send to the tech community?
Well, Larry Ellison,
mentor, right?
was a huge mentor of mine. I worked at Oracle for 13 years before I started Salesforce over 25 years ago, and I'm very proud of him. He has a vision for curing cancer. You saw it all play out. He's talking about it now quite openly, using AI to do it. He's taken a lot of the research ideas that have come out of his institutes in Los Angeles and Oxford, and now he is putting it into action, and I hope he's very successful and that all of us will benefit from his ideas.
Do you think that Stargate is a good signal that this will be a tech-friendly administration?
Well, I think it's going to be a much more business-friendly administration, which is not that difficult compared to the last administration, where there was no embracing of business at all. There was no discussion of how to amplify. Probably one of the great assets of the United States is our technology companies and our technology leaders. And at a moment in time where the whole world is becoming augmented by artificial intelligence, the United States has an incredible lead right now. It's very exciting, and I think that the administration should work closely with all of these CEOs so that we're able to be successful globally. And this is very important, that the government is part and parcel with what business is doing.
Are you concerned that President Trump, I guess, rolled back the AI guardrails that President Biden tried to put in place?
Well, I think we're still at the beginning of the administration. We don't know where all of this is going yet. So I think, as you know, I practice a beginner's mind, shoshin, the Japanese word for beginner's mind. And right now, at the beginning of this administration, I think it's best if we have a beginner's mind to see where everything is going. I'm very optimistic about what's possible. They have some incredible people working on this.
I remember you telling me, maybe last earnings call, Brian, agents could be used in government. Have you talked to Elon? Say, hey, we got to get these agents in government. They could be major cost savings?
Well, you're right. Agents in government, every government is going to, well, every company is going to benefit by being more agent first. I know that when I'm working with whether it's my state government or with my federal government, I never have somebody to talk to. So if I can talk to an agent, I'll be happy that I can actually get some of these issues finally resolved.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's go to Adidas, reporting better than expected quarterly results amid the sustained boom for retro sneakers like the Samba. They're citing that particular one. Shares right now up by about 2.4%. I would also point out some of the success that they've seen in basketball over the course of this past year as well. Anthony Edwards and the new silhouettes really catching a lot of eyes, a lot of attention, and I think that's really cemented their next play within basketball, even with some of the successes that they had seen with James Harden and, of course, Damian Lillard over the years as well. Anthony Edwards, representing a new face of the league, has certainly given them the opportunity on the marketing front and the product front to make their case.
Yeah, I think it's very much back to the basics when it comes to Adidas and what that focal point is, what their product pipeline looks like. When you take a look at the outperformance of the stock over the last year, shares have jumped just about 50%. When you take a look at some of the guidance that we are getting from the company, they aim to deliver double-digit sales growth and increase operating profit in the coming years. Now, all this coming despite some of those macroeconomic headwinds that we have been talking about, inflationary pressures on a global basis, obviously impacting consumer sentiment, how consumers are spending at this point. So they're having success in this tough macroeconomic environment. I think that tells us a lot about some of the momentum behind Adidas right now as they do try to narrow that gap with Nike.
Trying to get towards that 10% margin target that they put forward.
All right, let's take a look at Ford. Ford seeing a downgrade from Barclays, cutting the car maker to equal weight from overweight, citing volume headwinds due to inventory destocking as well as continued price normalization. You're looking at share losses of just about 3%. Digging into this, the analyst saying that it's unclear that cost actions will be sufficient to offset these drags. They also went on to write that this uncertainty leads us to step to the sidelines, at least for now. That's the analyst there from Barclays, Dan Levy. Now, he anticipates that Ford is going to deliver a slight fourth quarter earnings beat, though the guidance that we're going to get from 2025 will likely disappoint.
You know, we were talking about this with Tom Narayan yesterday in the context of what President Trump had been talking about in trying to get automotive production back to a level that we never thought fathomable, essentially. But it also comes with the demand consideration here and the volume consideration, which I think is the larger inclination for this call that Barclays is making here, understanding the consumer environment and also understanding exactly at what price point Ford is going to be able to hit a sweet spot in the future.
All right, we'll keep it right here on Yahoo Finance. That does it for Morning Brief. But my co-host Madison Mills and I have you for the next hour on Catalyst. Much more analysis coming up. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the U.S. trading day. Let's get a look at the three catalysts that we're watching this hour.
First up, we'll break down Trump's plans for tariffs as investors shrug off potential trade risks.
Plus, we look at the administration's plans for crypto as the SEC launches a new regulatory framework for the industry.
And we go live to the World Economic Forum in Davos as global executives discuss everything from artificial intelligence to trade.
Let's start with the latest coming from the World Economic Forum in Davos, Switzerland. Our very own Jennifer Schomburger is on the ground there. And Jennifer, when it comes to some of what's top of mind for business leaders, I would think it's some of the developments coming out of D.C. We heard from President Trump yesterday vowing to hit the EU, China, and Mexico, as well as Canada here with tariffs. Are you hearing anything about Trump's policies, or what are they saying? I'm sure you're hearing a lot. What are they saying about Trump's policies?
Shauna, folks have been very conciliatory here on the ground. Nobody wants a trade war, so we really haven't heard any stinging rhetoric at this point. I did hear from the governor of the Bank of France this morning. He says that while we don't know for sure the impact of Trump's policies, he does believe that the tariffs and what he describes as expansionary fiscal policies, translation tax cuts, will be inflationary for the U.S. Meanwhile, the World Economic Forum out with a brand new report today on the outlook for global growth, which they see will be weak this year because of uncertainty around the globe. 56% of economists surveyed in this report expect conditions to weaken further over the next year. China's economy projected to slow further over the next couple of years, but the U.S. a bright spot. Economists surveyed, 44% of them predict strong growth for 2025, compared with only 15% in the last survey. So a big jump there, perhaps attributed to Donald Trump's forthcoming policies. And the CEO of UBS weighed in on potential vulnerabilities within the financial system and which could lead to future financial crises. In particular, he's very concerned about government debt levels and the prospect for government debt defaults and crises in the future. Given how much debt a lot of countries are carrying right now, if inflation remains high and interest rates remain high, then that could cause certain countries to default if they can't bear the burden of those higher interest costs. Separately, State Street CEO said on a separate panel that he doesn't think that China is going to be a natural buyer of U.S. treasuries going forward, something that the U.S. has really counted on in years past. And also just want to note that UBS's emeritus also said that the shadow banking system is a concern for him because it's not subject to the same stringent regulations as the traditional banking system. He says that the prospect of deregulation, something that the Trump administration has put forth, actually worries him because financial companies, banks should be a resolution during a financial crisis, not a problem. Guys.
All right, Jennifer, thank you so much. Appreciate you joining us from the World Economic Forum in Davos. Here in the States, President Trump considering a 10% across-the-board tariff on China starting as early as February 1st. Despite recent threats against U.S. trade partners, including Canada and Mexico, the president has yet to take official action implementing any tariffs. Joining us now with more, Leland Miller, China Beige Book co-founder and CEO. Leland, great to speak with you today. So on the campaign trail, we heard about a 60% tariff on China. Now that he's in the White House, it's down to 10%. How are you thinking about clarity on what the actual tariff rate is going to be on China?
I think the appropriate way to approach this entire issue is from a strategy perspective and not from a tactical and revolving deadline perspective. What does the Trump administration want to do? They want to do a few things. They want to use tariffs for making deals and negotiating leverage. Sure, that's part of it. But a larger part of what this administration is planning to do for the next 4 years is use tariffs to restructure economic relationships. There's a belief that the trade deficit, the massive trade deficit, and some bilateral trade deficits are national security crises and need to be dealt with. And you've also got a separate component in which you have a desire to use tariff revenue being brought in order to pay for tax cuts and for domestic production back home. So you've got tariffs falling in several different buckets in several different ways. And when you look at China, the major thing is bucket number 2 is the economic relationship. It's how to fix that. There are issues involving fentanyl and other things. The president has that as a tier 1 priority. So it is top of mind right now. But I think when you look at this, some of the tactics have not been figured out. There's a lot of messiness in terms of the initial rollout. But I think you have to look at this in terms of what does the president want to accomplish and what will he do in terms of the first 10 days and then 10 months into this. I think it's going to be very different as this evolves.
Leland, I want to pull up a chart that we got from Apollo's Torsten Slok, and he very much outlined Chinese economy right now, where things stand, talked a little bit about the consumer. But I first want to talk about the U.S. and China trade relationship and the dependency or the moving away that we've seen from the two countries in terms of now they're not depending on each other as much. And that's very much illustrated in the chart that we have there. It's China exports to the U.S. as a percentage of the total. Then you have U.S. imports from China as a percentage of the total. And both of those lines pretty much steadily declining to the downside. What do you think that percentage will potentially look like by the end of the Trump administration? Is it going to be dramatically different?
Well, there's two key components to this. The first is whether China will import more. I mean, domestic demand in China has always been the key problem. They'll export to the world, but when it comes to demand, they're going to hoover that up for themselves. So the question is, will the Chinese buy more, either because there's a turn towards more domestic-focused consumption stimulus, or because they're forced to in some sort of trade deal? And the other aspect of that is Chinese exports. You see numbers go down, but that's not always what's really happening because of transshipment. So the Chinese have a wall around the United States for tariffs directly from China, then they try to ship things through Mexico or Vietnam or other places, Southeast Asia. So the numbers are not always the numbers, but the trends are the trends. And the trends right now is there's too many exports coming out of China. There's not enough domestic demand to bring imports up. And as long as that inequity continues, there's going to be enormous political friction, not just with the United States, but with the entire world.
How likely is that friction to lead to a broader trade war?
Very likely. I mean, what has President Trump been saying for years now? He's saying that this is a massive problem. And it's not just about the bilateral trade deficit and whether one number goes to another number. It's about structurally how the Chinese run their economy. And they have run their economy and doubled down in 2024 on more production, more exports, gobbling up manufacturing share from the whole world. These are trends that are not sustainable. You see them going up during COVID. There were a lot of exigent circumstances during that time. But since COVID, it keeps going up and up and up. And these are trends that are not going to be sustainable for the United States, for the European Union, for other countries to tolerate for much longer. So we've always said there was going to be a trade war regardless who the U.S. president was in 2025. But the fact that it's President Trump and he has laid out very clearly the way he views these things, I think the trade war is some sort is very likely this year.
Leland, what are the implications then of that and the escalating tensions between the U.S. and China, and what that ultimately means here for the TikTok debate and how that is going to end and play out here in the U.S.?
Well, TikTok obviously has nothing to do with economics per se. It is a valuable company that the president says he'd love to see a deal on, which is why he extended the shutdown an extra 75 days. Will we see Beijing come in and try to trade off selling TikTok in some way, shape, or form in return for some sort of insularity against moves like tariffs? I'm sure there's going to be discussions, but I think that this is secondary to the structural problems in the relationship. Even if a deal on TikTok is somehow made in the next 74 days or so, you still have the problems that are sort of spiraling in the wrong direction for U.S.-China relationship and China's relationship with the rest of the world. So these are things that are not going to get taken care of no matter what is done with TikTok.
But Leland, just given what we know about the relationship between the Trump administration and Xi Jinping and his administration, do you see, I guess, what is the possibility or what is the likelihood that we are going to see some sort of deal made?
Well, I think it has to do with, what the Trump administration decides it wants. If all they want is a bunch of purchases of commodities and maybe some sort of deal on TikTok, that's something that Beijing can very easily give up. Now, there'll be a lot of drama along the way, but that's something that I don't think Beijing cares about too much. If the push is to restructure the relationship, which again has been something President Trump has been harping on for years and years and years, and really seems to feel very deeply about, then that's not something that Beijing is going to give away easily. They're not going to, Xi Jinping's not going to wake up one day and say, okay, well, we've run the economy this way for over a decade. We're just going to, restructure the economy because the United States asked to. That's a very hard ask. It's something that's very difficult to do. So the question is, what is a deal? What would comprise a deal? There's an easy deal to be had, and there's a very difficult one to be had. The question is which one the United States goes for, if it does go for a deal.
More broadly, though, it does seem like deal-making is certainly on the table between Trump and China across tariffs and TikTok. I want to end, though, on the Chinese consumer. And this chart from Apollo stood out to me, looking at the number of workers per retiree in China dropping down to 5. It was at 10 just in the early 2000s here. So significant drop-off, just indicative of the weakness in the economy there. And I want to get your take on how that could weigh on American company earnings, specifically for those consumer-leading companies that rely on Chinese consumers for a significant portion of their revenue.
Yeah, well, look, 30,000 feet. What does this chart say? It says that domestic consumption in China is weak. It's been weak for years. It's getting weaker, and demographic headwinds suggest it's going to keep getting weaker and weaker. So we're talking about the structural, problems in the economy. These are all things that are going to get more difficult over time and more unlikely for China to double down and fix themselves without some pressure. So, again, demographics are not the only reason that consumption is going to be weak in the future. Structurally, consumption is not a priority of the economic leadership, and as a result, you've got these trade problems that are boiling up. So I think looking forward, it's very hard to see how these problems are going to be taken care of without increasing deterioration in the relationship.
All right, Leland Miller, always great to get your insight. Thanks so much.
My pleasure.
Take a look at the crypto market. Bitcoin moving to the upside today after acting SEC Chair Mark Ueda launched a crypto task force. Task force is meant to develop a regulatory framework for crypto assets, provide clarity around issues like disclosures, registration, and also what is legal in this space. For more on this, we want to bring in Rick Edelman. He's Digital Assets Council of Financial Professionals, founder of that. Rick, it's great to have you here on Yahoo Finance. Talk to me just about how big of a catalyst this is for the industry and whether or not this is something it looks like the industry, at least investors, are excited about it. But those inside of crypto, is this what they want to see from the administration?
Yes, it is. We're very excited about what's going on now after 4 years of blockage and obstinance from the Biden administration and the SEC Chair Gary Gensler. We're now seeing the chains unleashed. And as a result of this, we're finally going to see over the next 18 months all of the regulation and legislation that the crypto industry has been asking for. I mean, how many industries are begging Washington for regulation? We've wanted it in the crypto field because nobody knows what the rules of the road are. We're happy to obey the rules. Just tell me what the speed limit is. I'll drive within the speed limit, but don't pull me over for speeding without telling me what the speed limit was. That was the way it was under Biden and Gensler. And now we're going to get the clarity that has been lacking so far. And this clarity is going to not only provide us the rules of the road, but most importantly, it's going to allow banks and brokerage firms to engage in crypto. We're going to be able to custody and trade for client accounts. And that opening the door to banks and brokerage firms for the first time ever is going to unleash trillions of dollars of access, resulting in massive asset flows into crypto. And that's why you're going to see prices rise dramatically. And they've already risen a lot in anticipation of this.
Perhaps that regulatory clarity might apply to the president himself after President Trump and First Lady Melania launched meme coins ahead of the inauguration, and that Trump coin falling yesterday after Trump said this. Take a listen.
Well, I don't know if it benefited. I don't know where it is. I don't know much about it other than I launched it. I heard it was very successful. I haven't checked it. Where is it today?
So outside of the lack of legal clarity on meme coins more broadly, what does the existence of the Trump coin, of the Melania coin, do to legitimize or delegitimize crypto as an asset class?
Yeah, it's distasteful for sure. It's probably unethical. It's possibly illegal. And it's a huge distraction. The crypto community has worked really hard ever since FTX's collapse 2.5, 3 years ago. We've been working really hard to demonstrate professionalism and honesty and legitimacy. We've made a lot of progress, come a long way, and then you have this ridiculous distraction. But nobody can say they're shocked by it. I mean, we understand who Donald Trump is. He's a great leader, but he's also very self-motivated. And if he can make a buck, he's going to do it. He's got a great history of making a lot of bucks. And this was an opportunist moment for the president and his wife. And we have to kind of hold our nose to see that this is going to be a sideshow along the way of crypto legitimization, growth and development, and access to billions of people around the world. The crypto community is a little embarrassed by this. Not that it merely that it happened, but how it happened, when it happened, just days before the inauguration. And I think you're right. I think the new legislation and regulation will, I'm hoping, put a stop to stunts like this.
How big of an overhang do you see this being? Is this something that you think investors are going to brush aside in the coming days and coming weeks?
Yeah, they're going to ignore it. I mean, this is one of tens of thousands, hundreds of thousands of meme coins. It happens to be incredibly prominent because it's the president and his wife. But the end of the day, this is the sideshow. It's not going to have any material, long-lasting impact other than reminding legislators and regulators the need for rules and clarity.
I guess that makes me wonder, though, if it does put a cap on flows into Bitcoin as an asset class, if there are certain portions of the population that haven't gotten in yet that may see this as another sign of the asset class just not being on par with the traditional asset classes that we invest in, like stocks and bonds.
No, I don't think so. I don't think this is any more significant than institutional investors refusing to buy the S&P 500 because of the existence of penny stocks. So I don't see anybody drawing a conclusion saying that this is evidence I should stay out. If you're a crypto hater, you'll use this as an argument to hate crypto. But if you're someone who studies the technology, understands the incredible economic benefits to consumers, to businesses, to governments, you're going to recognize that the unleashing of the technological capabilities far outweighs the isolated sideshows that periodically crop up.
Right, let's talk about some of the excitement within the crypto market. Here we are today. You've got Bitcoin back above 104,000. Given what we've heard from the administration, the crypto-friendly nature, and the language that we're expected to get here over the next 4 years, what does that mean for the price? How high do you think Bitcoin's going to go?
Well, about a year ago, I came out with a prediction saying, and this was when Bitcoin was around 15,000 or so, that Bitcoin by the end of the decade will reach 500,000. I confirmed that today. I still believe that will be the case. I think Bitcoin will rise somewhere between 50 and 100% this year. It'll end 150,000 to 200,000 in value. It could even go higher than that. We'll see. But the reason for my optimism is because we are going to be creating the rules of the road that are going to allow institutional investors, endowments, pension funds, hedge funds, family offices, sovereign wealth funds, major Wall Street banks and brokerage firms to participate in this asset class for the very first time. You'll ultimately see Bitcoin available in 401k plans as well. It's already available, but in a small sense. And so we're going to see the availability of trillions of dollars of assets being available as asset flows. And since Bitcoin is still very small, it's only about $3 trillion in value, the total crypto marketplace, compared to $100 trillion of value in assets in the US, there is a huge upside left to go. And because Bitcoin has a limited supply, all of the new inflows simply result in price appreciation. It's the classic supply-demand scenario. So it's easy to see why Bitcoin is going to rise dramatically over the next 4 or 5 years. And I haven't really seen anybody suggesting that it's going to fall dramatically. But I do see an awful lot of folks arguing that it's going to perform extremely well and largely outperforming every other asset class.
Rick, there's always plenty of skeptics out there. Rick Edelman, we appreciate your time. Thanks so much. Coming up, we're taking a look at today's Yahoo Finance trending tickers. We'll give you the news behind some of the moves that we're seeing in the stock market here today. That's coming up next on Catalyst. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session, all done on Yahoo Finance's trending tickers page. First up, let's take a look at Abbott. Abbott Labs missing fourth quarter sales expectations, dragged down by weakness in its nutrition and diagnostics units. The medical device maker also forecasting first quarter profit below the street's expectations. Still, though, the company's full year outlook coming in line with estimates. A bit of a silver lining there. I guess you're looking at gains of just about 0.6%. But when you drill down into these numbers here, there is something to be concerned about. When you take a look at diagnostic sales, that declined on a year-over-year basis, coming in just below what the street was looking for. Pharmaceutical sales was up slightly on a year-over-year basis, although again, just below what the street was looking for. And the medical devices, that's the one that stuck out to me there. Bit of a bright spot there. They did see some improvement on a year-over-year basis, but again, not enough to really move the needle. At least it looks like here with that small gain that we're seeing so far in this morning's trading.
It's interesting, the double-digit gains in medical device sales in the context of their COVID testing. Diagnostics unit down by double digits as well, over 30%. It speaks to this idea of these companies having to continue to reinvent themselves following the pandemic. Perhaps that's a little bit of what we're seeing here with Abbott, but TD Cowen noting that any pressure on the stock that we saw after that slight miss this morning could potentially be short-lived. And Bloomberg Intelligence talking about how there could be more growth in that medical device sales unit throughout the rest of this year, which could be another tailwind to this stock and their revenue moving forward here. Next up, Citi resuming its coverage of Disney with a buy rating and a price target of $125, citing the attractive risk reward after a period of rating suspended from Citi. So again, just reinitiating their coverage here in this buy rating, but it's interesting what they say about Disney. They actually say that the street is a little bit too bullish, which I thought was really interesting. They are not as bullish as the average price target from the rest of Wall Street and analysts. Disney getting a little bit of a bid this morning off of that Netflix news already, and then just a touch more off of this coverage rating perhaps, but not too much. And it's interesting too, the bear case that they point out for Disney. They talk about the macroeconomic backdrop if we do see any broader consumer weakness, and they also say Universal Epic Universe could potentially pressure Disney World in the park. So I thought that was interesting that those are their two headline misses for Disney potentially.
Yeah, exactly. It is interesting, especially just given the performance that we've seen from Disney here over the last several months and really over the last year. If you take a look at a one-year chart, yes, we're looking at gains, but still significantly underperforming the gains that we saw from the S&P 500, for example. You're looking at gains of just about 14% on that 52-week basis. When it comes to why they are optimistic, I think a lot of that has to do with pure valuation, just a risk reward right now, how attractive that looks to them. And given their base case and even their bull case, you can kind of see some of those scenarios playing out, right? If the macroeconomic picture just improves just a bit, if consumers continue to spend, if cord cutting maybe slows a bit more than what they are right now currently forecasting within their estimates, that will lead to actually their more bullish case right now on the stock. But again, Citi covering or initiating their coverage right now with a buy rating after suspending their coverage there, 125 price target. So they're seeing some gains from here. We'll see how it all plays out.
Especially because, to your point, they also talk about entertainment and experiences being growth drivers, but they don't see a lot of growth in sports. So perhaps if you're the CEO, you just see that as an opportunity, not necessarily a ding to
Yeah, exactly. We've seen Disney take a number of initiatives with their ESPN arm just in terms of cost cutting. That's a strategy that we have seen play out over the last several years, whether or not it comes to top talent, whether or not it comes to some of the deals that they have with the league. So we certainly have seen a shift there, and that move is expected to be a further push in the direction that it's been going as well. Let's take a look at GE Vernova, missing fourth quarter revenue expectations, but still reaffirming their 2025 outlook, citing a strong finish to 2024. We want to bring in Chris Dendrinos. He is RBC Capital Markets analyst. And Chris, you see strong indications of some upside here. Why?
Yeah, thanks. I guess you could go back to the overall Trump narrative and the positive demand backdrop. You signed a number of executive orders on Monday, and you saw the Stargate announcement. That's right in GEV's wheelhouse. They are a leader in gas turbine manufacturing for power production, and then they have an electrification portfolio. And all that kind of lends itself to an opportunity to continue to support the electric grid. And so, from my perspective, the commentary on the call this morning was very, very bullish. They called out positive dynamics in demand, positive dynamics in pricing, positive dynamics in productivity. And so, there's nothing really to, at this moment at least, really poke holes into that would suggest that the trend is not going to continue up and to the right.
The one thing that I found a hole in, and I'm excited to get your context on this, Chris, is those tumbling wind orders as potentially part of the problem for GE Vernova. And I wondered if you think the focus on liquefied natural gas and oil under the incoming administration, the current administration, I should say, is that going to present an even bigger problem for GE Vernova, or is any shift in focus to other forms of energy just an opportunity?
Yeah, I mean, I guess honestly, it's a bit of both because they've got a very diversified portfolio of gas, nuke, and then wind. And so if there's wind weakness, the grid needs energy, and so maybe that's more of an opportunity for gas power, which actually carries higher margins for them. And now, to your comments on the wind portfolio. It's an offshore wind portfolio that continues to have losses, but there's an end in sight. And then onshore, it's a smaller piece of the business that has lower margins. And so, some of the announcements or executive orders from President Trump, at the margins could impact that onshore wind portfolio. But I think the key message there is that only 5% of total wind production in the U.S. occurs on federal lands where he's instituted a ban, and so it's a very small portion of the overall demand picture. And then, for GEV, they've got other parts of the portfolio that pick up and supplement that. So, overall, yes, some weakness in wind, but it's one of those segments of the business that expectations are extremely low, whereas everywhere else in the portfolio where they continue to outperform, those expectations are really high. So they're clearing the high bar and maybe falling short of the low bar, but the low bar is not that relevant.
Chris, one of the areas of that outperformance, a lot of that related to the AI boom. You have nat gas turbines more than double their orders, more than doubling to 20 gigawatts last year. They're saying they said on the earnings call that they expect 2025 to be even stronger. I'm curious what you're modeling out, just how big of a boom you're expected to see over the next 12 months.
Yeah, so I mean, this is the biggest head scratcher for me is just how much are they able to push pricing, and I think the narrative from them continues to be extremely bullish, and so they last year they announced an increase of capacity for their gas turbines. It was a 35% increase, and they've been pretty adamant so far, and commentary on the earnings call as well, that it's not going to go much higher than that, but they're fielding a lot of phone calls, and so. What do you do? Well, that's an opportunity for them to take pricing further. And so, for us, we're continuing to scratch this one and try to figure out just how much the opportunity is. But, I think the expectations amongst the investor group is, our 2025 numbers are already at the high end of the company's guide. I think, call it buy side expectations are above the high end of company guide. And I think there's, no signs right now, at least, that suggest that couldn't actually that won't occur. And the commentary from the company definitely supports that.
All right, Chris, we got to leave it there. Thanks so much for joining us.
Thank you.
Appreciate it. Coming up, Richard Dixon, Gap Inc. CEO, weighing in on tariffs and the state of the consumer from the World Economic Forum. We'll bring you that conversation from Davos.
No shortage of retail CEOs here at the World Economic Forum in Davos, Switzerland. We have a first-time Davos guest. That is Gap CEO Richard Dixon. Richard, I've seen you all over the world. New York Stock Exchange, Cannes.
That's right.
And now Davos. I know you've, over a year into the top job, done a lot of great work there. But how does Gap fit into the international scene? You've been U.S. focused, but what is the presence of this company, and where do you stand in this grand global stage?
Yeah, well, first off, we have certainly more than just the Gap brand. Gap Inc. has Old Navy, which is our largest brand, well known throughout the world. Gap, of course, Athleta, and Banana Republic. These are storied brands, decades young, if you will, with international presence. Europe, Latin America, Japan is a very big market for us, Asia. These are globally recognized brands and diverse in their footprint in the context of what they represent in each region, but ultimately a strong international presence, but a North American-based business.
I found an old clip of myself, Richard, when I was an analyst from 2012, and I said Gap was dead. And I thought to myself today, I look like a real ass today. I mean, but it was right for a certain period of time, but not under your leadership. Like, is the company officially saved? I mean, it's just Gap back, and we could stop thinking about the struggles of Gap from yesteryear?
Yeah, well, first off, I think we're all Gap fans. And I think that's what's most exciting, is these are brands where people connect to. And they've connected through peaks and pits and various different moments in time where we were less relevant. And the company, I believe, overall, through that, has been incredibly resilient. So this is a group of assets that, as we continue to drive our strategic priorities, putting more discipline into financial and operational rigor, we've stabilized the top line, we've expanded the margin component of our P&L pretty significantly, we've controlled inventory, we've done less promotions, we've controlled the SG&A, and now our operating margins are really getting back to some historical references.
How much sourcing is still left in China, and how concerned are you about potential tariffs?
Yeah. Our team has done an incredible job over the last several years diversifying our global manufacturing footprint. Less than 10% of our product is coming from China. We've got Southeast Asia, Central America, Europe, India. We've got various different places and ways that we've been developing over time, and we continue to develop even new markets for product development. So tariffs, they'll come, but ultimately it's our job to figure out the value proposition and make sure that we present our consumers with the best product at the best price with the best execution.
Are you spending outsized time at the board level even thinking about tariffs?
Our board is concentrating on our strategic priorities. I mean, tariffs are a dynamic and arguably one that we've experienced before. This is, again, a legendary company, 55 years young. There's a lot of events that have happened over that course of time, and the company's proven resilient through all of the trials and tribulations. We are going into another chapter of challenges, but again, as we stick to our strategic priorities, do what we say we're going to do, we're going to figure all the various different policies out with this new administration. We're optimistic about the future of our brands, and we're looking forward to working with the administration and dealing with all the various challenges ahead.
Do you have to, I had a conversation with the CEO of Suntory. He told me they were stockpiling whiskey in Europe because of tariffs. He has 1 year of whiskey in Europe. Is that a strategy you could employ? Will you stockpile merchandise?
We are really making sure that we manage our inventory really carefully. There are always timing issues with inventory that may have different fluctuations, but ultimately, and I think as you see our gross margin expansion over time, the discipline that we put into place, running a much more financial and operational rigorous model, is a big component of that is inventory management. And so we are running our business as we need to with the right inventory and the right time, and it's a fundamental fix that, again, with the metrics that we put on the scoreboard, is a discipline that I'm feeling much more confident about.
Before I let you go, when I first caught up, when you first took this job over a year ago, it wasn't the right time to ask this question, but now that you've settled in, should all these brands still be owned under this umbrella of Gap? Does that model still make sense? And it's top of mind for me, not only for your company. I'm talking to Honeywell CEO. His company is splitting up to drive shareholder value. Have you thought about this at all?
Of course, we think about it and we've analyzed it, and we believe the portfolio that we have in place is a powerful portfolio. We've spent a lot of time differentiating each one of our brands, as we talked about before. And now you go online and you start to feel brand storytelling that's distinct from each other. We're building a lot of capability and insights into making sure that we leverage our portfolio, study our consumer from the various brands, and offer the most distinct and unique product by brand. The platform that we have in the context of our portfolio can be leveraged in really exciting ways. Our global supply chain is one of the largest in the fashion industries. The value proposition that we get when we go buy fabric, when we negotiate, real estate, we're the largest apparel specialty player in the country. We've got great pride in that heritage, but we also have a strong negotiating point of view as a large leaseholder.
Sounds like you couldn't even unwind it. I mean, it would be very difficult.
It's very difficult to revitalize portfolio brands that you're seeing the progress that we're making. I believe by strengthening our platform and continuing to do what we say we're going to do in the middle of the P&L and now growing our brands on the top line, the platform is going to be leveraged, and there's going to be a lot of exciting ways that we share with our shareholders, various different ways to optimize and create shareholder value.
That's all Banana you're wearing, right?
It is all Banana head to toe, and a little bit of Gap and Old Navy in places that you can't see.
All right, well, don't make me blush there, Richard Dixon. We're just going to leave it there. CEO of Gap, always nice to see you, man. I appreciate you always making time for us.
Thank you so much.
All right, do stick around. Much more ahead on Yahoo Finance.
Some of the biggest names in big tech, including Oracle, OpenAI, and NVIDIA, are joining forces for an AI infrastructure build-out that's dubbed Stargate. More on what the venture means for these companies and their competitors, we are joined on set by our tech expert, Dan Howley. Dan, talk to me about not only what Stargate is exactly, but also how it benefits some of these big tech names and potentially hurts some of their competitors.
Yeah, so Stargate is this huge effort amongst Oracle and OpenAI and SoftBank, the three kind of big lead companies here for the project, to build out data centers across the country. And they're starting out in Texas, and so these would be data centers just dedicated to performing AI operations. And so, you imagine that we have other data centers from the likes of Microsoft, Google, Amazon. This is another kind of effort to ensure the U.S. has leadership in AI. And, bringing in SoftBank, obviously there was this discussion with Trump prior to the inauguration saying that there's this big push with SoftBank coming, in the hundreds of billions of dollars. And so this is clearly what that announcement was. What it means for the companies is, you have the likes of OpenAI, Oracle, SoftBank right there, but then you also have Microsoft in the mix. You also have NVIDIA in the mix. You also have ARM in the mix. And so these are companies that are going to benefit as a result of the kind of top three, the OpenAI, the SoftBank, the Oracle. The NVIDIAs will benefit because you're building out AI infrastructure. Guess who does the best hardware when it comes to AI infrastructure? It's NVIDIA. Microsoft benefits because OpenAI runs on Microsoft services. Oracle will obviously benefit immensely from using their cloud infrastructure as well as their data center infrastructure. And then ARM, just because, well, ARM is kind of everywhere.
It's up 17%.
Yeah, this is going to be a big deal for all of these companies. It's going to take time for it to be done, but when it is, you can imagine that companies will be leasing out the ability to run their AI platforms here and train them as well. So it's going to be huge.
Yeah, Dan, there certainly is a lot of excitement. You saw it play out in the markets yesterday. You see it play out in the markets here this morning. But Elon Musk pouring a bit of cold water on it, questioning the funding, whether or not these companies actually have the money that they're saying that they're going to put behind this project. How much should we be trusting some of his comments?
I mean, it's interesting, right? This is a initiative that Trump was obviously very proud of coming out of the inauguration, having the CEOs up there to kind of announce this with him, and then his kind of election bestie saying, not so fast, this isn't going to work, yada, yada, yada. And, there's a lot of animosity between Musk and OpenAI CEO Sam Altman. Obviously, Musk was part of the original founding team of OpenAI, split off, he's suing them. So there's that aspect of this, and you have to imagine, okay, is that why he's saying this? Does he believe genuinely that these companies don't have the funding? The $500 billion that's announced is the long tail idea for how much they want to spend, right? So they don't have to have $500 billion on hand right now. That's the expectation if everything goes well. So, I think part of it could be Musk just being annoyed that OpenAI is involved. And it'll be interesting to see what that means for the dynamic between him and Trump, just because they were besties. He's, been all over the place there. Now he's continuing to be himself on X/Twitter or whatever. What does that mean then for him and Trump?
Yeah, there's a lot of speculation as to how long it would take for something like this to happen and for him to start questioning some of President Trump's ideas. We're already starting to see it. All right, Dan, great stuff. Thanks. Well, Google is investing another $1 billion in OpenAI's rival Anthropic. That's according to a report from the Financial Times. This investment is in addition to over $2 billion stake Google already has in Anthropic. The partnership allowing the two companies to co-develop AI systems, and Google uses Anthropic's Claude model in its online cloud services. Amazon is also a big backer for Anthropic, investing $8 billion in the company over the last 2 years. The tech giant planning to use Claude in its next generation Alexa speakers. This new funding from Google coming just weeks after Bloomberg News reported that Anthropic is in talks to raise $2 billion in a round that values the company at $60 billion. The competition in the AI startup space is fierce. OpenAI's latest valuation putting it at just around $157 billion, and Elon Musk's XAI at $45 billion. Coming up, we're discussing some of the top themes for ETF investors in 2025. We've got that investment playbook for you when we come back.
Our next guest has 3 themes investors should keep in mind for 2025. Broaden your equity horizons, stay invested, focus on income, and lastly, put your cash to work. ETFs are one way to do all of that. Here on set, we've got Marissa Ansel, Goldman Sachs Asset Management Head of ETF Investment Strategy, and she's joining us in studio for this week's ETF report brought to you by Invesco QQQ. Marissa, great to have you. So these 3 investment themes that you point out to us, I want to start on broadening your investments. How do ETFs allow investors to have an avenue for broadening their equity exposure?
Great. Well, first of all, thanks so much for having me on the show. It's great to be here today. So, as we look at the equity market today, levels of equity market concentration are really at all-time highs. We currently have more than a third, almost 40% of the S&P 500 in just 10 names. And so we are really advising our clients to make sure that they're not overexposed to the largest cap stocks and actually making sure that they're not missing opportunities further down the market cap spectrum. And in particular, we think that small caps are likely to be big beneficiaries as the market starts to broaden. And we expect equity market returns to start to broaden this year as we look forward. And I think, as I look at the market backdrop for small caps as an asset class this year, I think there's a pretty good setup, for a couple of reasons. So one, the economic backdrop is really supportive. And as you guys know, small caps tend to be very domestic focused. Number two, with interest rates coming down, that's a really nice tailwind for small caps. They tend to be a little bit more sensitive to the cost of capital. And number three, valuations are still really attractive. So the average small cap stock typically trades at about a 2% discount to large caps. Right now, they're trading at almost a 24% discount to large caps. And then putting that all together, the icing on the cake is that actually, and we were talking about this at the back end of last year as we were coming into 2025, and we said we expected there to be a pickup in M&A and IPO activity. And we've seen exactly that, actually. So in the last 3 weeks, we've had 5 takeouts of small cap stocks, and we very much think that that's going to continue. So I think as an asset class, it looks really good. The setup looks good for small caps. But I would caution, I think you absolutely have to go active in small caps in particular. And the reason for that is, it's a really inefficient part of the market. It's less well researched than the larger cap end of the equity market. So that's great for active managers if you can pick the right stocks. There's a lot of potential to generate alpha. However, almost 30% of small cap companies are actually still loss making. And so it's actually really, really important to make sure you avoid those companies. You definitely don't want to buy the whole benchmark in small cap. And so, in GSC, which is our small cap equity ETF, we do exactly that. It's actively managed by a very, very experienced industry leading small cap investment team. And we're really active, really nimble, and we really focus on quality stocks.
So it's important to broaden your market exposure, but again, to do your homework, just given some of the risks surrounding that. One of the things that you're also focused on is staying invested and focusing on income, which Maddie just mentioned a moment ago. What's the best way for investors to do that through ETFs?
Yeah, great question. I think, right now, there are always risks on the horizon. There are always uncertainties. We're very focused on managing risk. Our clients are very focused on how to mitigate risk in their clients, in their portfolios. One way that I think a lot of clients are looking at staying invested, but also generating income, is looking for thoughtful investment strategies such as derivative income ETFs, which allow them to have equity market exposure, right? So GPIX as an example, or GPIQ, these are the Goldman Sachs core premium income ETFs. They provide S&P 500 exposure and NASDAQ 100 exposure respectively. But we also have an actively managed call writing overlay on top. And that's what allows us to actually generate income. And so they generate 8.5% and 10.5% annualized distribution rate, which is huge, particularly in the current environment where rates are falling. And I think what's even more important is that it's not only a very attractive source of income, but it's actually a source of income that is uncorrelated to falling interest rates. And so I think that's a way that investors can, stay invested, maintain that capital appreciation potential, but also, realize a nice healthy income stream.
Final 45 seconds here. Money market funds still at record highs.
Yes.
Is it time for that to change?
I think it is. I think we're overdue a change here. We've got nearly $7 trillion sitting in money market funds at an all-time high. And I think investors really need to start to put that cash to work, because that cash is earning less and less as rates come down. I think we've got a couple of interesting opportunities in fixed income right now. I think the first stop out of money market funds is ultra-short duration. GSST is our ultra-short duration bond ETF, where, just for a modest increase in duration, you can really open up your opportunity set and generate incremental yield. And the other area that we're really excited about actually in fixed income is municipal bonds. And we're seeing great opportunities here. We launched a suite of actively managed municipal bond ETFs last year. And here, GMUB, as an example, is actually generating a tax equivalent yield, because of course, remember, munis are income tax free, the tax equivalent yield of nearly 7%. So I think that stacks up really, really well in the current environment.
Great for our viewers to keep in mind. All right, Marissa, thanks so much.
Thanks for having me.
Wealth is coming up next.
It's time for Yahoo Finance's Market Minute. Stocks are higher as optimism around AI growth outweighs tariff concerns. Netflix shares surging to an all-time high after topping earnings expectations and reporting its biggest quarterly subscriber add ever in the fourth quarter. The results spurring analysts to boost their price targets on the stock, Jefferies even calling the results, quote, near flawless. And Oracle and a slew of other AI stocks are higher after Trump announced Oracle is teaming up with OpenAI and SoftBank for a joint venture called Stargate. They will invest $500 billion to build out AI infrastructure in the US. We're seeing NVIDIA and ARM shares rising along with Oracle. Amazon also having a good day today, notching a record high intraday high. Analysts at Raymond James boosting their price target on the company, citing the outlook for generative AI growth. And that's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session. Wealth starts now.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and the tricks that you need to grow your money. Hey, on today's show, we're examining your portfolio. One financial advisor reveals why investors should feel comfortable moving their cash off the sidelines despite policy uncertainty. And trading for Trump 2.0, we break down how you can play the options market with 3 picks one guest says are due for bigger breakouts. Plus, paying for higher ed. We discuss what a Trump presidency means for student loan borrowers. Plus, an expert gives us tips for current students and older borrowers. All that and much more coming up during today's show. But first, let's begin, as we always do, taking a look at some of the market action here on the day. We're higher across the board 90 minutes into the trading day. Stocks rising right now as boosted by strong earnings and some tech optimism. Joining me now, we've got Liz Miller, who's the Summit Place Financial Advisors founder and president. Liz, good to have you on the program with us. You say investors should feel comfortable getting into this market. Why is that?
Well, we know there was a lot of cash on the sidelines all throughout last year from investors who sort of felt like they missed it and kept saying, is now too late, is now too late. And then there was a lot of profit taking into year end. So we know there's a lot of cash on the sidelines. And when we get days like today, this great strong day, a lot of investors, again, will say to themselves, well, let me wait, maybe I missed it. But, one of the big things we're seeing it today and really over the last day or two is that, the market that was a little bit sideways the beginning of this year with uncertainty is now breaking out. It's moving higher. And all those underlying trends in our economy that we knew were good for the market, earnings coming, a decent employment outlook, are starting to come through, and we little by little will get rid of that uncertainty of what policy looks like this year.
And it's policy two-pronged, right? Because it's policy that's coming from 1600 Pennsylvania Avenue as well as from Capitol Hill, and that policy aimed at what Trump and President Trump and his administration will target in terms of tariffs. And then the other side of that policy is, okay, if tariffs do get implemented and there is some type of pass-through to inflation, how does that impact Fed policy here? How are you striking a balance, especially as you're charting forward your own portfolio strategy?
What we've done for the most part is continually balance those two policy uncertainties, as you said, the Fed versus fiscal policy and potential tariffs coming out of Washington. But one thing we all know, it's nice to have a president who we know a little bit about, and we understand as investors that the right step is to wait and see the actual policy. And you see that in the long term in the markets, that in the short term, we do see that volatility when comments are made and they suggest much higher tariffs and inflation that can come down the pike. But if we stick to a discipline of understanding the underlying U.S. trends are good domestic growth, good earnings growth, and reasonable capitalization of companies, we found last time and we'll probably find this time around, that will come through in the markets because the discussion looks a lot scarier than the policies that end up really taking hold.
Let's focus in on the Fed a little bit more here as well. When you think about the amount of rate cuts and what that would also need to sense and really kind of say about the economy more broadly, if we did get to that point later on this year, it seems like it's not until later on this year that we will see, and in the back half of this year, that we might see any type of rate cut coming from the Fed. What's your anticipation there?
We do expect to see some rate cut this year, but clearly a lot of uncertainty. And what we're seeing in the bond market, the fact that longer maturities have moved higher, is those experienced bond investors getting ahead of the Fed. They're really telling the rest of us what they expect out there. There's a real feeling that the Fed doesn't have much strength right now. It's almost like we kind of talk about a lame duck Congress. It's almost a lame duck Fed for the next year. And so we're going to look a whole lot more at what the bond market tells us about concerns. And really, the 10-year is a little over 4%. And if you look at long-term history, that's not that high. We've just spent the last 5 to 7 years used to these unusually low rates. But a 3% inflation environment, a 4+% 10-year yield is very average for long-term history and has never put the brakes on an economy.
Liz, just lastly, while we have you here, I want to get some actionable picks right now that you're targeting, especially even as we began the conversation saying that this is still a safe market to get into. Where are the top areas that you're prioritizing?
We're prioritizing investments that have a strong domestic exposure because of that global uncertainty. Over 40% of revenues in the S&P 500 come from overseas. So one of the first things we've been talking about that was spoken about on the last show is small caps. We do like the exchange traded fund for the Russell 2000. We look at the IWM. Small caps are at very reasonable valuations. They've lagged. And when we see a stable environment and ongoing growth, they have a lot of potential for upside, and they tend to be very domestically focused, most of the companies there. So we think if you're a mutual fund or index investor, this is a great choice right now. We also like the REIT area, which is also lagged behind and is very U.S. domestically focused. One of the leaders there being equity residential. The United States is still very underbuilt for residential housing, and EQR is one of the leaders in that segment of the real estate market.
Liz, thanks so much for taking the time here with us this morning. Appreciate it.
Great to see you.
Good to see you too. Now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the sessions with Yahoo Finance's trending tickers page. Joining me now, we've got Catalyst co-host Madison Mills here, and we're tracking a pair of analyst downgrades this morning, Maddie. First up, Reddit. Reddit cuts to neutral from buy at Roth Capital Partners. The analyst Rohit Kulkarni, who we've had on the show before, writing fourth quarter performance and first quarter guidance setup is, quote, not for the faint of heart. The analyst arguing that Reddit's valuation is above that of its peers. 2025 fundamental optics are, quote, mixed at best. The words in this particular call here. What do you make of this?
Yeah, it's not that surprising when you take a look at Reddit's stock run. It's been on such a tear. He notes that since the August low, it's up 270%. It's not really a question of anything wrong with the company. It's actually the opposite. It's that they've been so good over time. And you're taking a look there over even the last 6 months, up by triple digits for Reddit. It's just a question of that revenue growth and whether or not it's going to sustain with the street's expectations. He notes, as you point out, revenue growth could decelerate every quarter with somewhat deteriorating incremental EBITDA margins. He does say a risk to his call, which would be good news for Reddit shareholders, is that they could come up with new products and potentially that the Wall Street bets AI investors could potentially keep the stock lifted for longer. So we'll just have to see what those retail investors do to the stock moving forward.
Yeah, it's been quite the surge since this company went public here. Of course, we were both here on the desk to be able to break that down.
Yeah.
Also, we got to talk about Yum Brands here, and we're going to get hungry and ready for lunch off of this one. Yum Brands downgraded to market perform from outperform at Bernstein. The analyst citing a more pressured outlook in their algorithm in 2025 here. Shares right now, they're holding on to gains, though. They're up by about 0.4%.
I think it's interesting. There's a lot of good news within this, at least for the consumer. They talk about in this print from Bernstein just the idea of increased expansion opportunities on margins, for example, particularly due to the fact that you've got consumer spending that could potentially keep Yum Brands up here, which I think is interesting given that we're in this context of a questioned market when it comes to the consumer. They do note GLP-1 adoption as a risk, but that there's still uncertainty about how the GLP-1 movement is going to go with regards to people being able to afford GLP-1s more broadly moving forward. This is not one of their top picks for 2025, but they do note that they just see, broader increases to Yum Brands moving forward here, and to Darden restaurants, I should say, actually, as part of their upgrade here. For those other restaurants, Yum Brands, though, I should clarify, is a downgrade within this note.
Yeah, it seems like their top picks continue to be Chipotle and Starbucks here, and then additionally, saying Wingstop, which we've had some own debate within our newsroom about Wingstop before here. We can talk about that at a later date. It's interesting. They also pointed out some of the policies that may shake profitability here for the sector, and notably talking about tariffs on China, and then also talking about the labor pool potential shrinkage amid greater immigration controls in the U.S. And a possible impact there here. So that factoring back into the Yum Brands downgrade.
Even mentioning RFK Jr. and potentially that Make America Healthy Again initiative being a headwind as well. So lots of policy impacts to talk about.
Maddie, great to break these down with you. Thanks so much. Appreciate it. We're going to turn now to a check of the housing market. I want to bring in Yahoo Finance senior reporter Danny Romero. Danny, let's start first with mortgage rates. We get those tomorrow. What's the lay of the land?
Well, buyers still remain on the fence. Mortgage Bankers Association, the association that tracks mortgage applications, showed that mortgage applications rose 0.1% from the prior week. That is such a small increase. And the reason is mortgage rates are hovering over 7%, which is hindering both activity for refinancing and purchasing. But we also have to remember that buyers are dealing with elevated home prices. Redfin reports that home prices rose 5.4% on an annual basis. Now, this is the smallest annual increase since 2015, but economists say that prices will continue to go up because there's not a lot of inventory that will be hitting the market. Some economists even say that there will be more sales activity this year compared to last year because there's a lot of pent-up demand, but it's unlikely that that will put pressure on home prices. Brad?
Now, Danny, we're seeing a lot of headlines about the rental market as well. What is the story that you're tracking there?
Good news. The rental market still remains attractive. Rents continue to fall, according to Realtor.com. That's because new construction is outpacing rental demand. Remember, there was such a big construction surge in 2023, and so renters are reaping the benefits of this construction boom that happened. However, on the single-family home front, there's such a big demand for single-family homes, and there hasn't been a lot of construction for these types of homes. And so rents continue to go up. They're about 40% higher than pre-pandemic levels for single-family homes. Now, inventory just hasn't been able to recover, but there is a lot of discussion right now whether or not the new administration, the Trump administration, how they're planning to alleviate some of these pressures, whether it comes on the rental front or purchasing front. Brad?
Danny, thanks so much. Tracking all things housing market. Appreciate it. Coming up, the macro trends to watch in 2025. We'll break them down. Stay tuned. We've got much more wealth after the break. Our next guest is tracking a few macro headwinds and tailwinds we could see under the second Trump administration. For more on this, we've got Jason Bronchetti. He was the Chief Investment Officer at Lincoln Financial Group. Jason, good to have you here with us. So first and foremost, as we think about those potential headwinds and tailwinds, what potentially are you tracking here at Lincoln Financial Group, and what could potentially play out?
Yeah, well, first of all, Brad, thanks for having me. It's great to be here with you. And there's a lot going on. The one question that we've been getting the most from clients has really been around the new administration and what that might mean to some of the specific headwinds and tailwinds. And it makes sense. We're at a point of certainly considerable volatility as well as noise around what might be shaping the economy from a policy perspective. So if I take a step back and think about that, some of the tailwinds we see certainly from a new administration have been really focused around the tax reform, reduction in taxes, both at the consumer and the corporate level, which have the impact of improving profit margin and improving income for individuals. In addition to that, deregulation, something that's clearly front and center, and I think something that can be accounted for reasonably easily and can be implemented more quickly than perhaps some of the things that take congressional input and influence. So some positives out there, certainly driving things along with just animal spirits. On the negative side, though, longer term with the new administration, there are some headwinds that we see out there, most notably tariffs, trade. We know some of that's out there. I do think that some of the political hyperbole is now going to meet some congressional reality and some of the other kind of the realities of the political system. But nonetheless, that tariff policy is potentially a headwind, as well as deficits, which we know have caused rates to rise, albeit calming down a bit here more recently. But so those are some of the key headwinds, tailwinds. But the big thing for us, we're taking a step back and trying to make sense out of all the noise out there, helping investors settle in. We serve about 60,000 financial professionals and 17 million customers. And what we try to do is distill down that noise, bring it to those financial professionals, investors to make sense and cut through the noise.
With those headwinds and tailwinds that you mentioned, what kind of sector dispersion are you anticipating?
Yeah, we're definitely seeing an opportunity for some other sectors to perform well that haven't most recently. And I think you look at that from an administrative perspective. I think the financial sector as well as the energy sector have the potential to perform well. They've certainly not performed as well of late. We still like, technology still makes sense. I think that the Mag 7, as much as they've run, they are companies that have real economic moats and real value to be added. So we're talking a lot with folks about just taking the time to check in, think about rebalancing your portfolio. It's a good time to do that, given the run-up that we've seen in the markets over the past couple of years. I mean, 20% years back to back, led by that Mag 7, may be causing for some impacts in the portfolio that may be unintended. So just making sure that folks are taking the time to rebalance and think about their allocations, as well as just diversification, thinking about ways to diversify the portfolio, not just from a sector perspective, but from a more of an asset class perspective, value, international, et cetera, and also bonds. We've seen that bond funds have really suffered given the rise that we've seen in interest rates over the past couple of years from a total return perspective, but it's really a great time to be adding income to the portfolio. So it's another thing that we like. And then third, I'll say is private markets. We're definitely seeing an opportunity for private markets. We invest in them considerably within our own general account on the institutional side, and we're seeing more and more opportunities for individual investors to take advantage of private market strategies that have historically only been available to more institutional or high net worth individuals.
So that kind of spells out a portfolio checkup for investors and looking for areas to rebalance.
Absolutely.
What would you say is a good rule of thumb as part of that rebalance?
Well, I think that the rule of thumb is always to think about your financial objectives, your liabilities. We think about asset liability management very much as an insurance company. We want to think about what it is that we're trying to achieve, what those objectives are, and then design a portfolio that over time will meet those objectives, regardless of the economic backdrop. So try not to think specifically about the particular point in time of the economic backdrop, thinking through the cycle, thinking about the duration of your liabilities or when you'll need income, retirement, et cetera, and really making your planning from a portfolio perspective, from that long-term perspective, such that you can achieve those goals regardless of the noise that's out there in the market around us.
You call the last few years a roaring 20s for the markets. What are the chances that this trend trend will continue? What do we need to see in the back half of this year that sets up perhaps the second part of the 2020s?
Yeah, absolutely. So, we've seen 2 consecutive years of more than 20% growth in the S&P 500. And this in and of itself is not necessarily a reason to be bearish. We've done some good research on this. Going back since 1950, there have been 8 other instances in which we have seen 2 consecutive 20% plus back-to-back years in the S&P 500. And of those 8 instances, 6 of those times saw markets higher a year later. So 75% of the time, the market's gone higher later and gone higher by a considerable amount. 12% is the average return. Now, typically it does come with some degree of downturn in the process. And I would say statistically, I wouldn't be surprised to see some type of a downturn in the markets here, given the volatility that we have seen. Average market will have a downturn of roughly 14%, and then go on to produce new highs. So I wouldn't be surprised to see that happen. But I think big picture, if we take a step back and think about the economic fundamentals, the economic fundamentals are key, and they still look pretty good. You've got growth is easing, but still growing. We saw the leading economic indicators were in line today. A little bit softer, showing a declining trend. The labor force has softened, but is in pretty good balance. And inflation, the Fed has done a pretty good job with inflation. So against that backdrop, things look pretty good. I mean, we say that there's an old adage that bull markets don't die of old age; they're murdered by the Fed. And I think the reality is that the backdrop sets up pretty well for the Fed right now. While that easing may subside, because the economic growth is pretty good. So be mindful of what could be out there. We could certainly see some exogenous shocks that could change things. But where we sit right now, and where we are in this particular bull market, that's about 27 months in relative to a typical bull market on average, which runs over 5 years. The backdrop looks pretty balanced with certainly opportunities for growth and a bit of volatility along the way.
Lincoln Financial Group Chief Investment Officer Jason Bronchetti, thanks so much for taking the time.
Thank you.
Investors are parsing through a flurry of activity in the first few days of the second Trump administration and presidency. Our next guest joins us with 3 call options that investors can use to cash in on the new administration. With me now, we've got Matthew Tuttle, who's the Tuttle Capital Management CEO and CIO, for an option segment sponsored by Tasty Trade. Matthew, good to have you here with us. So let's start with your first one. It's a play on drones with aerospace defense company AeroVironment. So walk me through this call.
Yeah, so there's a few things going on with this. First off, what the war in Ukraine, I think, showed us is the future of warfare is drones. And I can't help but, think that as well when I'm watching Trump's motorcade the other day, and they're talking about how it's fitted with anti-drone technology. Bringing this now to kind of the administration and the policies, first thing they did is they closed the border. Well, how are you going to do that? We don't have the wall built yet. There are not enough Border Patrol agents. There are gaps. How do you fill those gaps? You fill it with drones. So they're going to need to use more and more drones at the border. And then they've named the Mexican drug cartels as terrorist organizations. And somebody asked Trump, hey, are you going to send in special forces? And he said, well, everything's on the table. But are we going to really send troops into Mexico? Probably not. We're going to send in drones. So I think drones are the future of warfare. Anti-drone technology's got to be built up. We're going to use it at the border. We're going to use it against the cartels. I think it's an under the radar screen kind of Trump theme that you want to be in. And AV is the leader here.
Next up, you also like Coinbase as a way to play President Trump's pro-crypto tilt. Walk us through that one.
Yeah, so what you saw and have been seeing over the past couple of days is now we've got the first ever pro-crypto president, pro-crypto administration, more importantly, pro-crypto SEC. We saw a slew of ETF guys, including me pretty soon, filing for a bunch of crypto-related ETFs on almost every coin imaginable. All of that stuff has got to be custody to Coinbase. Plus, the Trump coin, the Melania coin, right now for people to trade that, Coinbase. So I think Coinbase is positioned perfectly here for what's going on in this administration.
Yeah, I had a couple of friends notify me once they got the alert and the notification that Robinhood had finally listed those meme coins that you mentioned a moment ago. And finally, you see more upside for Trump ally Elon Musk's Tesla here. So as we've been continuing to try and figure out what the Tesla trade is here, you're looking at a particular options play around that.
Yeah, so, we think Tesla's a name you've got to be in. Elon Musk was the biggest winner, I think, of the election here. The stock ran up. It's come back in somewhat. They've got their hands in so many different areas. Me personally, we run TSLT, which is 2x long Tesla. I would buy options in that. But, for the faint of heart, you could buy options in, the regular 1x as well. I just think Elon Musk is in so many different areas tied to what's going on, in AI, in robotics, and he's definitely got Trump's ear.
Just lastly, while we have you, Matthew, and this is some fresh news that we've seen come across over the past 24 hours with regard to investments in what is being called Stargate. And as you look at some of the companies that are going to be beneficiaries as a result of that, where do you kind of start to think through the options analysis and the potential plays?
So again, those are things we want to be in long term. This is happening so fast. You don't know when an announcement is going to come out. So, Oracle is, I'm in January Oracles and have been. ARM is a name you want to be in. The below the radar screen here is healthcare and AI. Nancy Pelosi came out, bought Tempest AI, TEM. That's another option I've been in for a while. What does Nancy know? Be interesting to find out. And the only thing that they talked about in that press conference yesterday was healthcare and AI. That is going to be the future. So you want to be looking at those healthcare names. Tempest is the big one. Schrodinger is another one. RxRx. There's going to be more and more and more advances there. That is an area you want to be looking at.
Matt, thanks so much for taking the time here with us today. Really appreciate it and breaking down these calls.
All right, thanks.
Certainly. Coming up, we're bringing you a conversation with Ralph Lauren, CEO from Davos. We've got more wealth when we return.
Lots of big name retail CEOs here on the ground at the World Economic Forum in Davos, Switzerland. One of those big names, Ralph Lauren CEO Patrice Louvet. Patrice, good to see you. We've now talked around the world. I cut a promo ahead of this interview, and I teased that Ralph Lauren is a company exposed to tariff risk. It's a company maybe that does a lot of business in China. I'm not sure I got it 100% correct. Help us understand your international sourcing. How exposed are you to China, Europe, et cetera?
So we've diversified our sourcing pretty dramatically over the past 7-8 years. We used to be very dependent on China. China was more than 50% of our sourcing. Today it's low single digit, mid single digit. What we've come to realize, and this is true for sourcing, but it's true for our overall approach as a company, is diversification is critical, right? So diversifying our supply chain. So obviously we're paying the attention to tariffs. As you can imagine, we didn't start to think about it yesterday. We've been planning for this for a while, but I think we're nicely set up to navigate this more volatile environment because of the diversification of sourcing that we have, whether that's markets in Asia. We have a lot of nearshoring, both here for North America or here in Europe. And for us, this ability to flex and to stay agile and nimble, I think has served us pretty well and is going to continue to be a priority.
Can you get 0% from China? I mean, can you fully move out of China?
China has some unique expertise in certain categories for us. Some of our more sophisticated sweaters are made in China. Some of our more sophisticated footwear is made in China. I think under duress, we could always find alternatives. And as you can imagine, we're running all types of scenarios to be prepared. But again, what's important for us is multiplicity of sourcing options. I don't want to be dependent on just one market or one supplier, and agility and the which honestly was honed during COVID, right? And then the flexibility that was required during that time.
Is a 25% tariff on China, is that a duress moment?
Well, it's a pressure point, but again, I think we can work through it and we can manage it. I think we've lived with tariffs already. It's not a new concept, and we've been able to navigate that.
Does it mean higher prices for U.S. shoppers?
It likely translates into higher pricing for consumers at the end. Yeah.
I was speaking to a board member of a large electronics company here on the ground, and they said every board meeting now is involved with tariffs. Most of their meetings are fully thinking about how do they reposition supply chains. I mean, are you thinking about other things at the board level besides tariffs?
Brian, we are not obsessed with tariffs.
Okay.
We are obsessed with our consumer. We're obsessed with making sure we're giving him and her an incredible experience around the world. We're obsessed with bringing new consumers into the Ralph Lauren world. We're excited about the Australian Open partnership we have going on there right now and many other things for this coming year. Tariffs is part of running the business. And listen, there's regulation is another element. There are a number of elements we need to take into account to successfully manage the business. This company's been around for 57 years. We've seen many administrations in the US, around the world. We've seen many different policies around the world. I think if we can stay really focused on the consumer, making sure we're staying true to who we are and what we represent, we will be able to navigate.
Is the US consumer, are they in a better place?
I think we'll report our holiday results in a couple of weeks. I think that our consumer is pretty resilient, and that's true in the U.S. and that's true in most of the key markets. So I'm hopeful that with this new administration, we'll see a greater degree of optimism from consumers. I mean, they've had a tough time since COVID, right? And I think the mood's been pretty gloomy since COVID. So hopefully, there's more optimism, but ultimately translates to more engagement in brands and categories like ours.
I've been amazed, I think we talked about this before, I've been amazed by the store closures by department stores. I mean, Macy's, a lot of legacy locations. How is this shaping the future of a company like yours?
So for us, the filter is very clear. We want the brand to show up in a place where we can tell our story authentically, and that's profitable. And it's pretty clear, and you and I have talked this in prior months, that we were over-distributed, and we are in locations where we could not showcase the brand in the right way or that were not financially viable. As you know, as we've talked, we've reduced our footprint in North America by about 2/3 of department store doors, which I think was required. It's enabled the continued elevation of our brand, so I feel very good about that move. And I think some of the statements that you've seen from Tony Spring at Macy's saying he's going to shut down 150 doors, I think is right. I think if you cannot provide the consumer with an amazing experience and great service, then you should close.
What does the tie-up on the other end? You had a merger of Saks and Neiman Marcus. What is that? I mean, these are two iconic luxury department stores. How does that change the complexion of your business?
So those are separately two great partners with whom we've been doing business for many, many years, and we love the relationship that we have with them. I think this will strengthen both entities, so 1 + 1 = 3. And listen, strong partners is beneficial to companies like ours. So I'm excited about the move. I'm excited that Mark will be leading that transformation, and I think both companies have things to learn from each other. I look forward to a lot of the Saks digital capabilities translating into Neiman's, and there are other things that will go the other way. But I think that's a positive move for the industry.
Ralph Lauren CEO Patrice Louvet, good to see you. We've now talked around the world.
Fantastic.
Yeah.
Looking forward to being in Asia with you.
Yeah, come on about all that, but maybe back in New York City. Patrice, good to see you.
Thank you, Brian.
Student loan borrowers who signed up for President Biden's SAVE plan are currently in forbearance, meaning their loan provider can't collect payments, but the Education Department is also blocked from forgiving debt. That's just one of multiple changes expected as we head into and are beginning a new presidency. Joining us now with some advice for borrowers, we've got Scott Buchanan, Student Loan Servicing Alliance Executive Director. Scott, thanks for joining us here. What changes might we see, and are we already beginning to see under Trump?
Yeah, so I don't think we've seen a whole lot of sort of specific announcements yet, but I think what's likely to occur is probably a return to repayment options that existed prior to the previous administration. including during the Obama administration as well as the previous Trump administration. So some of those things include repayment plans that are more flexible than they were 10 years ago, but certainly probably not at the level that the Biden administration had been promoting.
So what other programs should borrowers know about?
Sure, today, while the SAVE plan has been enjoined by the courts, and so folks are sort of stuck in a limbo as it relates to that, there are other income-driven repayment plans that exist today, like income-based repayment, income contingent repayment. All those things are available, including PAY, which is a previous Obama administration repayment plan. So if borrowers are really close to loan forgiveness under like public service loan forgiveness or other things, they can explore those repayment plans and move from SAVE into those, especially, like I said, if you're really close to loan forgiveness through another sort of federal program under the law.
What are your tips for borrowers who may be signed up for the SAVE plan and aren't sure what to do?
Yeah, I mean, and listen, it is a challenging environment right now. It's unclear sort of will SAVE survive? Will the new administration continue that plan? Will they rescind that plan? I think really what I always advise is you have to make decisions, especially personal financial decisions, based upon what's in the law today, what's available today. So don't, pin your hopes on what might or might not occur in the future, but explore the options that exist today. And there are plenty of them. To help people who are struggling or having difficulty making payment, and they just pick up the phone and talk to their federal servicer, we'll be able to walk them through what options they do have in front of them today under the law as it exists.
So what are your tips for current students as well?
Yeah, I mean, I think, it's always, whether it's current students or those who are sort of beginning to explore what they're going to be doing next, is making sure that you're looking at choosing a degree in an institution that's going to really offer you financial value. I mean, in many ways, higher education is probably the largest investment that people will make prior to buying a house. And so making sure that when you graduate and when you leave, you've chosen a major that's going to translate into income that's going to make, if you took on student loans, make that debt manageable and make it a wise investment that will pay off in the long term. So be very thoughtful about what degrees and what institutions you're going to.
How are we seeing that perhaps even alter the thought process about universities and programs that students are going into?
I think, sort of the broad discussion that's been going on over the last, whether it's, 5 or 10 years about the cost of higher education, including things like the rise of student loan debt in this country, have been a real indicator for families that it's time to start really thinking about this as a financial transaction, right? And looking at programs that if it's going to cost you 30 grand a year to get a degree that's going to have minimal financial impact on your ability to make money when you graduate, that's probably not a program you need to go into. And colleges and the universities, I think, are taking a hard look at this as well to make sure that the programs that they have available are actually going to translate into success for those people rather than just costing a lot of money to get a piece of paper that isn't really worth anything in the market.
Scott, thanks so much for taking the time here with some very valuable tips for students and borrowers out there. Appreciate it.
Thanks.
Let's get a check of the markets here as we've continued to track the major averages over the course of today's trading session. We're taking a look at the major averages fractionally higher across the board. The Dow is up by about 0.2%, the S&P 500 up by about 0.75%, and the NASDAQ, you're seeing that up by about 1.4%. Speaking of the NASDAQ, we've got the NASDAQ 100 heat map here up for you right now. NVIDIA, you're seeing some gains there on the day, up by about 4%. We'll round that off too. Additionally, taking a look at some of the other mega cap tech stocks. As you're taking a look at Amazon, that's also up 2% here during today's activity. I want to focus in on Apple for a hot second here because I was able to take a look at just what the last month has looked like for this name here, and it's actually pulled back by about 13% over that course in time here. A few things, of course, that have been coming to light about the company as well as the consumer demand, especially in a key region for growth in China as well. And so we're going to be continuing to track Apple here with some of the slippage that we've seen there. However, elsewhere, of course, Meta right now, you're seeing that move higher on the day as well. That's up by about 2.6%. And then also just want to get a quick check in on some of the sector activity that we're tracking here for you today. 11 S&P 500 sectors. We've got them pulled up here for you on the screen. Utilities pulling up the caboose. Right now, that's down by about 1.6%. But technology, even as we were taking a look at the NASDAQ 100, you could see a lot of green that was on the screen with a little bit of red peppered in. And technology, XLK, is reflecting that. That's up by about 2.25% right now. Coming up, Americans, they're back on TikTok. But not all services have been restored just yet. We're breaking it down next.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot. Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
A programming note, new Yahoo Finance podcast alert here. Slate Stone Wealth's chief market strategist, Kenny Polcari, partnering up with Yahoo Finance to bring you some clear, accessible insights on the movements and trends shaping global markets. On today's episode, Kenny speaks with Bullseye American Ingenuity Fund Portfolio Manager Adam Johnson about the differences between investing and trading. Let's listen.
So I am an investor. I'm not a trader. Right. You have to know what you're looking for.
100%.
And I always tell my clients, we focus on time in the markets, not timing the markets.
Right.
And so my approach is if I can project out 2 or 3 years and look at the cash flow and see a pathway to, say, 15 to 25% earnings growth for each of the next several years, and I can put a forward PE, price to earnings multiple, on that future cash flow and arrive at a target that represents a double, maybe a triple over the next several years, I'll buy it. And I don't worry about these pullbacks.
Right. You can watch Trader Talk with Kenny Polcari every Wednesday at 12 p.m. on Yahoo Finance or wherever you get your podcasts. It's time for Tech Support, our weekly check-in on all things technology. President Trump signed an executive order extending the deadline for TikTok to find a U.S. buyer by 75 days. He also suggested a billionaire like Elon Musk or Larry Ellison could buy the app.
Are you open to Elon buying TikTok?
I would be if he wanted to buy it, yeah.
And on your inauguration,
I'd like Larry to buy it too. I have the right to make a deal.
But there's still some uncertainty about what you can and can't do on TikTok in the U.S. right now. So we've got Yahoo Finance's Dan Howley here to help us out a little bit. Let's start with those deals, Dan. What are some of the potential U.S. buyers? Who are they that are on the table right now?
Yeah, well, obviously there's Musk. He is Trump's, I was saying this earlier in the morning, Trump's election bestie is, I think, the way I want to phrase that going forward. Then obviously Larry Ellison. One of the folks that he had mentioned there. But then there's also Mr. Beast, the YouTube personality, wants to get in on the action. We have Frank McCourt, obviously has brought this up before. And then Kevin O'Leary, who's repeatedly said that he wants to purchase TikTok. And so those are really the major players that seem to be in the running. Obviously, Elon Musk already has Twitter/X. So, you have to wonder if that would be okay. That doesn't seem like it wouldn't be, just because they're such different apps with such different audiences. But yeah, I mean, those are really the main folks who are potentially set up to buy this app.
And some of those are, of course, names that are once again reboot names, because some of them had efforts, and thinking of Larry Ellison, to buy TikTok previously during the first Trump administration.
Walmart too, remember
Walmart
that?
too,
That
I
was
do.
involved. What was going on?
So here's what a lot of users want to know. What can they do with TikTok right now and some of the other ByteDance apps at this juncture?
Yeah, I mean, we were covering the kind of turn on and turn off, or turn off and turn on of TikTok over the weekend, around 10 o'clock. I think Saturday, East Coast time, it had gone off, 10:30, and then it had come back on Sunday. And if you tried to load the app, it just basically said it was dead. But now it's back. You can go through TikTok. You can use CapCut. That's what you would use to edit videos. You can post videos. You can do most everything on there. However, if you deleted the app or you don't have the app already, tough luck. You're not going to be able to download it on Google Play or the Apple App Store. And if you have Marvel Snap, which is an app that's partially owned by ByteDance, which was also cut off when TikTok went down, you can't download that, and you can't make in-app purchases for the app via App Store. So those are some of the things you can't do, and we don't know when you'll be able to do those again, just because when it comes to browsing, that's on Oracle, that's on the cloud providers, but when it comes to downloading, that's on Apple and Google, and they might not have the appetite for risk that Oracle might have when it comes to this kind of endeavor.
Absolutely. This could be very costly if we don't see a buyer as well here.
Oh, yeah.
We're going to be tracking this very closely. We know you will as well. Thanks so much. That's it for Wealth, everyone. I'm Brad Smith. Thank you so much for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.